enterprise fix it. And the Google announcement yesterday was really, really important. I heard that from all sorts of sources, that it was a massive symbol to large and complex companies that they can go it alone.
Anne-Marie, just quickly, have you heard anything about this in Washington, whether the administration is working with some of these large multinational companies, the big employers, to follow suit, to do the same thing?
Facebook as well yesterday saying all U.S. workers need to get vaccinated. I agree that that does give some political cover. I haven't heard anything that they're working directly, but I would not be surprised. The direction of travel is certainly moving towards private institutions, private companies, institutions like University of Indiana. They are getting political cover if the U.S. government is coming out and saying, we want all of our workers to get vaccinated.
And this is where it gets tricky if you don't have a good relationship with private business. Anne-Marie, thank you, down in Washington, D.C. I'm thinking of a man here in New York City that doesn't have the greatest relationship, Lisa, with private businesses.
Yeah, indeed. I just want to, though, follow on the idea of private versus government cover to make these moves. Part of it is also that they don't know how to reopen their offices, private corporations, given the fluctuations in the Delta variant. I mean, Twitter basically closed its newly reopened San Francisco office in response to the Delta variant, some of these guidance measures that the U.S. Is giving out. So I do think that some of it is just given to them as the necessity if they want to get people back to work when people go back to school in September.
Alphabet, Twitter, and others delaying that reopening, that return to office, Tom. You wonder if Wall Street starts to follow. There's been an aggressive pitch here on Wall Street by several of the big names, several of the big banks. You wonder if they back away from that.
John, I would suggest it is Thursday into Friday in the summer. A lot of people, 3 days, 4 days, even weeks off next week. There's going to be a lot of meetings taken today on this issue.
September is a very interesting time. Lisa, you mentioned the return to school. That's critical.
Yeah, did you see that New York City is now paying people $100 to get vaccinated? And so, of course, the conversation is, can you get vaccinated again?
What do you think the rest of the world thinks about that? The fact that New York City is paying people $100 to get vaccinated.
Well, they struggle to get enough vaccine to meet the demand. Yeah, I think that that's an interesting public relations issue.
Unbelievable. Tom Keene, Lisa Bravitz, Jonathan Ferro. Your equity market looks like this on the S&P up 9, advancing 0.2%. Yields are higher by 3 basis points to 126.59. For our audience worldwide, this is Bloomberg Surveillance.
If inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
Billionaires in space?
What defines going to space?
There is a level where you
It's
get
the common line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around, and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing
This
that I
is a
mentioned and you
big
carried on
physics
talking and
thing.
ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio. Global markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition, weekday mornings on Bloomberg Television.
Live from New York City for our audience worldwide this Thursday morning. Good morning. Here is the price action. In the equity market this Thursday, we're positive 0.2% on the S&P. We're negative about 0.1% on the Nasdaq, and we're positive almost 1 full percentage point on the Russell. It is a do no harm week for policymakers in the Federal Reserve and in China too. I'll get to that story now. Switch up the board and get to the bond market. 127.63 is where we closed on 10s last Friday. This is where we are right now, 126.76. And if you look at the week, it's as if that Fed meeting never happened. Yields, 126.76 on 10s, Tom, 191.43 on 30s. Yields higher there by 3 basis points or so. Same is true in the FX market for dollar China. It is a do no harm week for Chinese authorities. As Lisa pointed out a little bit earlier in the program, China convening the plunge protection team, it seems. What happened to dollar China?
Right.
Switch up the board and get to dollar China. The Chinese currency stronger. And this move, Tom,
my word.
the biggest move we've seen actually
whatever.
since January. Dollar China, 645. 83. Nothing's entertaining you this morning, is it, Tom?
No, what's entertaining me is John Folks has a team of about 20 people to get him to real yield on Friday. And John, what I would recalibrate on real yield off of that huge move we saw off Chairman Powell yesterday is not so much the nominal yield, but the inflation estimate that gets you to the residual, that real yield. And if you listen to David Rosenberg, that inflation residual is going to come in with a vengeance, and you're going to have a real yield that recovers.
Just to be clear here, are you calling that a huge move yesterday? Is that what you just did?
I think it was substantial.
That was substantial.
I think we went out to record negative statistics on real yield. I don't think enough has been said about it.
We can do that now if you want. Do you want to carry on?
No, I'd like to carry on, but you're going to go into planning with your team on the real yield, and
What did you expect?
Is this the editorial meeting now?
No.
Is this it?
You've got your team to.
I think
get
our
you
audience
through
would like us to continue, Tom, with the show, if you want to.
Yeah, well, kids, I can go either way. Jack Ablin's like, what am I doing here? Jack Ablin joins us with Crescent Capital, our Chief Investment Officer. What does the real yield signal, oh, wise one? Jack Ablin, there it was spiking out to record negative yields yesterday. Is it a so what?
Well, apparently for the Fed it is. There's obviously no incentive for the Fed to do anything. Record negative real yields suggest that financial assets, if left alone, will deliver, negative purchasing power. And so one of the themes that we've been playing was a shift out of financial assets into real assets. And, our allocation is added to gold over the last year or so.
Where's gold here at 1,800? I mean, is it linked to all that's going on, or is it a beast of its own?
Well, I mean, the fact that, it just treads sideways at around 1,800 is not a bad thing. We're not looking for it to beat equities. We're looking for it to really just maintain purchasing power over time. So I'm viewing it as more of a cash alternative. And, if it creeps higher with prices, that's great. Because certainly someone locking in, a 1.2% 10-year yield is doomed to fall behind the standard of living.
They said that at 150 then, and then we rallied, Jack. And I just wonder, does it provide any buffer in the portfolio to have that 10-year, to have that treasury mix in there?
Yeah, I mean, I think it does. I mean, we're using bonds as really an expensive luxury to just match cash flows. It's the only asset class besides maybe lottery winnings that can offer you a specific dollar amount on a specific date. So when we're trying to match cash flows for our clients' spending, bonds are there. But beyond that, I don't view it as much of a buffer. It just isn't much yield to do that with.
Lisa, we came into this year and there was a huge conversation about the 60-40 portfolio, and there was a massive question mark above it. I wonder what that conversation sounds like now.
I love the idea of bonds as a luxury asset class, this idea that you're just having the luxury of basically earning a little bit less than perhaps nothing. But you know what? Honestly, the negative real yield, going to Tom's point, John, does raise a question. What are savers earning at this point based on the real inflation rate? The least ever.
Not much at all. And Tina is ringing in my ears now. Jack, Tina, there is no alternative. Is that all this is about now in this equity market? Go on, Jack.
Yeah, I think there is. I mean, this been the theme of financial repression for now the decade. It's just really coming to a head. I think what are some of the implications are, the fact, we talked about the Fed put, forget it. I'm not sure unless they want to start buying equities or, putting on cheerleader outfits. I'm not sure that the Fed's going to stand by. So I think they're long-term equity investors facing an equity market at record valuations need to understand that if we do get a downturn, not sure where the circuit breakers kick in.
I want to jump in with a stock move, Jack. I want to get to DD Global in the pre-market. Now up just 13.75%, up by 12% now, Tom. The roulette continues. It's a break of 10. We need the chart here. If you can get the chart pre-market, that's what we want to see right now. So I can show you the surge and then show you the rollover off the back of DD saying the rumor that it could go private is not true. That's according to Reuters. And Tom, just to frame this for people that have just tuned in, the big move came from a Dow Jones story that read as follows. Ride-hailing giant DD Global is considering going private in order to placate authorities in China and compensate investors for losses incurred since the company listed in the US in late June. So it's Dow Jones on the one side, Tom, Reuters on the other, and this stock is now just at about 10, positive 13%.
We are honored that people like Jack Ablin watch us each and every day. We've got a huge global audience of Global Wall Street. This is a window into what we do every day. It's not just John, Lisa, and me, folks. This is about, we cite the news where it comes from. In this case, as John mentions, Dow Jones states up we go. And then Reuters comes out and says, maybe not. What you don't hear or see is what's in between, where people like Martin Schenker and Kieran Buchanan are scrambling with all of our resources to look at these rumors and these speculations. And John, once again, our team has absolutely nailed this.
Jack, just looking at this story and how it's evolved over the last month, how investable are some of these names now, given what's playing out?
From a macro perspective, we don't think that Beijing is getting out of the capitalism business. I think that, they are certainly going after some of the larger players, particularly in tech. But I think that all in all, we're actually on the prospect of buying DD at this point. We don't have it in our thematic portfolios. It just came out. But we're, going to be adding it.
Jack, on a broader level, are you interested in buying Chinese shares in general, particularly the beaten up education sector and some of the other areas? Because there is this buy the dip moment. The Chinese authorities have shown that they are uncomfortable with too big of a sell-off.
Yeah, I think that there is a buying opportunity in China and emerging markets in general because of it. But, I'm more of a macro guy. I'm not going to come in and start picking individual names or sectors. I'd rather just play the general theme of China and allow that to play forward. So, yeah,
just to be clear, though, Jack, you did just say earlier, though, you guys would be looking to add DD Global. What would that add for you?
Yeah, DD Global is part of a much broader theme we call next generation transportation. It's a global thematic portfolio we have. It fit the parameters, and the fact that it was beaten up between June and now is, for us, a good thing.
Jack Kaplan, Crescent Capital Chief Investment Officer
Really valuable.
and founding partner. Thank you, sir. Just to frame this for our audience that might just be tuning in, I'll give you the information and you can do whatever you like with it. This is the stock move right now on DD Global in the pre-market. It's positive a little more than 13%, pushing 14 percentage points higher to 10.12. The IPO price was 14. We had a surge earlier this morning off the back of a Dow Jones story that read, quote, in the lead paragraph, ride-hailing giant DD Global is considering going private in order to placate authorities in China and compensate investors for losses incurred since the company listed in the US in late June. That's Dow Jones. Then Reuters out just moments ago, and the stock turns around on this headline, Tom. According to Reuters, DD says the rumor that it could go private is not true.
My basic take here is to listen to Chinese authorities, whether it's Leland Miller, China Beige Book, the wonderful Elizabeth Economy at the Council on Foreign Affairs. And John, their basic take is, well, you know what? The government's in charge. The government's making the decisions here. I saw overnight somebody got an 18-year sentence, some executive in China. This is serious stuff.
It is, Tom.
With serious consequences.
And we're getting some commentary from the company itself on Weibo. So this is the official line from them. They say the privatization report is not true. They say it is not true. So look, that's what comes from the company. We've had the reporting from Dow Jones. This is the direct line from the company. More broadly, though, what Jack Kaplan just said, I think is really, really important, that they're looking to buy that stock as part of a broader theme. And that is the risk at play here. For the people who have bought a basket of this stuff, and you see moves this big, you end up seeing other big moves in things like, say, Uber, Lisa, which is exactly what was happening with SoftBank yesterday. And this is the transmission risk, the contagion risk. This is how it builds. It starts isolated, and then it starts to bleed out because people buy this as a theme in a bucket, in a basket, part of an index, whatever it may be.
Especially as China becomes more mainstream in terms of indexing, in terms of its inclusion in stock portfolios. And this is one thing people were looking for. We didn't see a big note of contagion over the past week or so when some of the sell-off was really gaining steam. There is a question, Tom is talking about Chinese authorities and how they have been involved, and this really is their market. Yes, so the question is, how tolerant will they be of a sell-off? The fact that they are uncomfortable with how severe the sell-off has been is giving some people comfort. However, the balance of where their priorities are with respect to their society is still unclear in terms of how far they'll go with the capitalistic economy.
Do you think that changes things for investors? The next time a Chinese company, no idea when this is going to happen, but the next time a big Chinese company goes public in the United States, Tom, what's the attitude to that IPO going to be?
They'll make it up as they go. Good luck to them.
Has that shifted permanently now?
I got my own opinion on this that nobody cares about, but the answer is they'll make it up as they go, led by their Western bankers.
DD, 1038. That stock is positive by a little more than 16%. Up next, on the pandemic, Jennifer Nuzzo, Johns Hopkins Center for Health Security Senior Scholar from New York. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. That $550 billion infrastructure passage has cleared its first barrier on Capitol Hill. The Senate voted to begin consideration of the bill. 17 Republicans joined all Senate Democrats and 2 independents in voting for the measure. Lawmakers expect the final passage to last into the weekend or possibly even next week. The new chair of the Federal Trade Commission is vowing to return to the agency's trust-busting roots. Lina Khan told reporters she intends to use the FTC's full arsenal to take on companies that are preventing competition. Khan also signaled she is not afraid to take on risky cases that officials have shied away from in the past. China may be preparing for a period of prolonged tension with Washington. Beijing's new ambassador to the U.S. is a veteran diplomat known for pushing back against Western criticism. Qing Chang most recently served as vice foreign minister. He told reporters he would work to put U.S.-Chinese relations back on track. Now, Royal Dutch Shell is stepping up its effort to win back investors. The energy company raised its dividend by 40% and said it will buy back $2 billion of shares shares. The move comes more than a year after Shell slashed its dividends by 2/3. And it's one of the most anticipated listings this year. Robinhood has raised $2.1 billion in an IPO, priced at the low end of a marketed range. That gives the trading app company a market value of just under $32 billion. Robinhood shares do begin trading today. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Some of the best deals in history have been passed on by a very large number of people. The money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
That over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
We are going to go for the full license, and the teams are working very hard to file a so-called BLA, biological license application, and we will do this over the next 2 to 3 months. before the end of the year for sure.
Pascal Soriot there, the AstraZeneca CEO from New York City this morning. Good morning. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Here's the equity market, the price action shaping up as follows this Thursday morning. Jobless claims out a little bit later this morning, 8:30 Eastern time. The S&P 500 positive 4, positive about 0.1%. Yields are higher by 3 or 4 basis points to 126.93. Let's call it 127. Euro dollar firmer, stronger by 0.25%, approaching 119 again, just creeping higher on the euro side of things. A stronger euro, Tom, 118.75.
John, and for radio, I have something new. I have a new look today, which is, John, I put in my pocket on the way to work today.
There we go.
A mask.
Had you not been using that in the Uber, Tom?
I've not been using that in the Bentley, and you know, it's just, you know, we got the shield.
I'm not sure that's in line with protocol,
right.
but carry on.
But you know, there's the mask. Jennifer Nuzzo joins us now to tell me when I'm going to put the mask on as well with Johns Hopkins. Jennifer, as simple as I can, I'm confused. Am I going to be less confused by Monday?
I hope so. We need to be less confused by Monday. But, you know, listen, I think there's been a lot of change in guidance, a lot of discussion about do we need masks now? But the fact remains, if you're fully vaccinated, you are still very well protected against the thing that we care most about, whether you get sick and that puts you in the hospital. If this virus couldn't do that, we wouldn't have heard of it. I have to keep reminding people of that larger picture there.
I'm just lost. I mean, yesterday was, I mean, John's clear on this. Lisa spent 3 hours yesterday studying this. What's the goal of the CDC on Thursday to get us to less confusion on Monday?
Well, supposedly one of the things that they're going to be doing is releasing more data on the what we apparently now know about breakthrough infections. They said that their new guidance that vaccinated people may, in some circumstances, need to return to masks, that's based on new science. We haven't actually seen the new science. We've known for a long time that it's possible that people who are fully vaccinated, that they can get infected and sick. But we always knew that the vaccines were protective against serious disease. That said, if you live in an area where there is a whole lot of disease and most of the people around you are not vaccinated, which those two things are probably linked, if you live in that area, you may want to wear a mask if you are the kind of person who never wants to get a cold. You may also want to wear a mask if you're someone who lives with someone who's really vulnerable, who, despite maybe also being vaccinated, is, you know, the kind of person who we really worry about, you know, people who are elderly or have underlying health conditions that may not give them the same level of protection from the vaccine that the rest of us have. Or I can imagine that some parents who are really worried about their unvaccinated kids might say, listen, it's not a big deal for me to wear a mask for a few more months until hopefully I can get my kids vaccinated.
Jennifer Nuzzo. That's exactly where I wanted to go. The question of children and the Delta variant. And there's been some mixed messages in terms of how sick they get from this variant. Anthony Fauci saying a small subset are getting very sick. We're seeing hospitalization rates in younger individuals creeping significantly higher. How dangerous is this variant for the youngest cohort that is not eligible for this vaccination yet?
So we have no evidence that this variant is particularly dangerous for young kids. It's just that when the number of cases go up, they go up in, you know, proportionally in all age groups. And of course, kids, you know, are many of them are too young to be vaccinated. So, you know, they have additional risk than someone who is older enough to get vaccinated. But I think for parents, they shouldn't worry that this Delta is suddenly more deadly for kids. The risk of serious disease from infection in children is still extremely low. There unfortunately have been, you know, a number of children who have had serious disease and you know, a few hundred deaths, which of course is a tragedy. Most of these kids have had underlying health conditions. And so for that reason, you know, I think parents aren't without worry, but I'd also want to give parents a little bit of ease that all the things that you've been doing for the last year and a half to protect your kids remain important. And, you know, when and if vaccines become available for kids, that'll be another option.
Jennifer, do you think that this was a misstep by U.S. health authorities, that they really took the wrong approach here in shoring up credibility among the population?
Well, I think one of the challenges is that they had been saying that if you're fully vaccinated, you don't need to wear a mask. Now, of course, anytime the science changes, we have to update our guidelines. That's just good practice, and that's just how science works. I think the challenge is that we haven't seen what they're basing that guidance on, and that I think has raised more questions. But the overall premise that if you're a vaccinated person and you're living somewhere where the disease is raging around you, it is of course true that if you wear a mask, it will give you more protection.
Jennifer, where are we on the science hysteria meter? I know they have the meter in the labs at Johns Hopkins. The last 24 hours to me have been just absolutely nuts. I hear all sorts of innuendo. I hear adults like Adalja and Nuzo and the rest of them, Hotez, all of you people killing yourselves on this. The essential workers, you guys must be just aghast at this. How much of this is science and how much of this is just flat out hysteria?
Well, you know where we are right now, the hysteria, everything that we're doing right now. All of this would go away if people got vaccinated. And that is really, I think, what's fueling it all, because that is why we're even having to talk about masks.
Would it, though, Doctor, given what we're seeing play out in Israel?
Yeah, absolutely. I think the cases in Israel are going to come down very shortly. We already see them coming down in the UK. So it's my hope that that will happen to Israel. I also hope it'll happen to the United States. But I really want people to get vaccinated, because any additional cases, hospitalizations, and deaths that occur when we have a tool on hand that can, prevent serious disease, that's just a tragedy. So let's avoid that.
Jennifer, thank you. It's good to get your view. Jennifer Nuzzo, Johns Hopkins Center for Health Security, senior scholar. A lot of people, Tom, taking some comfort from the direction of travel in the UK at the moment, with cases rolling over, moving in the right direction again.
Okay, where are we on this, John? Am I going to go to LHR here in the next couple of weeks? I mean, I talked to one of our fans, Al, who said he wants me there now.
You can fly to the UK very soon, I think, Tom, without quarantine. And you can fly directly back without quarantine. I can't join you, though. Maybe that's a good thing for you. Maybe you're happy with that, but you can go.
I'm sorry, I'm confused, folks. I mean, after yesterday, John, I got the mask here, and I don't know.
Well, I tried to clear that up
is
yesterday
Apple,
too. Tom, a lot of people are with you. I understand.
Is Apple going to make me wear a mask if I have to go in and buy afterthought something today?
If you go into one of their stores, you will have to wear a mask again, yeah.
Why?
That's what they've decided.
Okay.
Would you like to speak to Tim Cook?
Yeah, well, we have an interview with him, I think,
coming
up.
To those questions
I was going to talk about free cash flow, but maybe we'll talk about the mask.
I think it's interesting that actually, if you look at the vaccination rates, which a lot of investors are doing in order for a leading indicator, you're seeing them tick up pretty significantly, particularly in areas that have been pretty hard hit by the Delta variant. So to me, I find this interesting that the best treatment, perhaps, to get people to get vaccinated is an increase in incidence.
There is a shift in this country in the last week from New York City alongside Tom Keene and Lisa Abramowitz.
That's the first thing you said well today.
Thank you, Tom. Thank you for the S&P. Such a great team you've got.
Be a Didi data check. I need more Didi here. I need more Didi.
Is this why they separate us?
Got that right. We're medically sealed.
It's a science experiment.
They should have seen it when it was just us on radio.
Oh, Lisa,
before Lisa came in between us and we were throwing stuff at each other. The cameras weren't on us then. You've got to behave now from 30 feet away.
You spilled my tang.
Yeah. Luke Cower's next. Who's he? From New York, this is Bloomberg.
up to Maine and had a lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
We've shown that if you give enough fiscal stimulus, you can get a strong economy.
Each central bank is trapped, and they're not going to be able to exit this unconventional monetary policy.
They're all using models that are traditional models, but this has been a very non-traditional recession.
Monetary policy cannot combat the major problem to the economy.
Having some cash to deploy and look opportunistically for sellouts is a good idea.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
It's the day after the Fed and all is quiet. From New York City for our audience worldwide, good morning, good morning. This is Bloomberg Surveillance Live on TV and radio alongside Tom Keene and Lisa Abramowitz. I'm Jonathan Farrow. Equity futures up 7 on the S&P, advancing almost 0.2%, Tom. A snoozer of a Fed meeting for some people out there at least.
Very successful for Chairman Powell, there's no question about that. And I thought Michael McKee, that was his analysis as we ended the show yesterday. What I see, John, within the week of back and forth, and you frame the 10-year yield, where are we right now? 1.27%. What I would suggest, John, is we're sort of walking around with a VIX 25 gloom, some real, not like outright fear in that, but there's just some angst out there of VIX 25, and the VIX is actually at 17.70, not all that bad.
Do you want some volatility, Tom?
Please.
Do you want me to go there? DD Global. Let's go there. Let's frame this debate.
I think it's been minutes since we've looked at this.
On radio, DD Global now positive by 16.9% after surging 30, 40 percentage points off the back of a Dow Jones story that indicated the company was considering going private, and then the company itself, Tom, coming out and saying, no, that's not true. This stock has been all over the place, and it's been the poster child for what's been developing in Beijing.
It has been, I mean, I don't have a lot of wisdom to put in here, John, other than clearly, as I think Lisa mentioned in the last hour, Chinese authorities have stepped in the last 2 days and begun to rumble as government officials can do.
Yeah, and Lisa, that's certainly the broader story.
Yeah, and this is one thing that's giving people confidence that perhaps Chinese officials won't go too far with their regulatory measures to pare back some of the more aggressive tech areas. Again, though, it highlights how uncertain the field is for data. There is a fight for data. Chinese government officials want the control over it. They are concerned that the U.S. could have access to it. They are concerned about IPOs in the U.S. and, frankly, vice versa. And this is going to be a lasting theme, John.
And that story's going nowhere anytime soon. That is the issue at the moment. Here's the issue this morning. Not much to talk about. It's a snoozer in the equity market. Futures are up 6 on the S&P, up a little more than 1/10%. Yields are higher.
Oh,
Have a move there.
There
you go, Tom. Up 3 or 4 basis points. 126.76. Euro dollar 118.74. A stronger euro advancing, Lisa, 0.2%.
John, we got to stop the show. Can we just
What on, euro dollar?
No, 6 months ago, 8 months ago, that 4,400 even print on SPX was unimaginable.
I agree with you. Year-end median right now, Tom, 4,300. From the strategists that we survey, that's the median now, year-end target, 4,300, and we're north of that already.
We heard a 5,000 number yesterday.
Still got to close out July. We put Scott Minerd on the spot, though, didn't we? Can't just throw out 5K. You need a time horizon. What did he say? Over the next 12 months or so, he can see us getting there.
He said or so, but still, you got Minerd saying 5,000. You know, I'm still triple leveraged all cash, but hey,
Thanks,
Minerd's
Tom.
at 5,000.
Lisa's waiting patiently. Let's get to Lisa. Let's
I'm
run through the
enjoying
day
this.
ahead.
Do it all on Didi.
I'm drinking my Tang and really loving this. I will say, what we're looking for today could give a little bit more drama to the Fed meeting that we got yesterday. The idea here that jobless claims are really coming into focus. All jobs data, in my opinion, are taking on new significance after Fed Chair Powell said, we have not made significant further progress. We have made progress, not significant further progress. We're not there yet, and it is because of the jobs numbers. They want to see big headline prints. What kind of progress do we get? And does this mean that there's renewed volatility around some of the jobs information that we're getting? We're also going to be, of course, getting GDP reading expected to be about 8.5% on an annualized basis, a near record high. 1 p.m., the all-interesting 7-year note auction. The U.S. is planning to sell $62 billion of these notes. These tend to be a more volatile sale. sale. At this point, though, given the demand for bonds, perhaps they, like the other auctions, will be snoozers. However, it will be interesting to see if perhaps this answers the question that even Fed Chair Jay Powell couldn't answer, which is why are bond yields so low? Why have they gone lower after the previous Fed meeting? He didn't say he had a clear answer on that except for technicals, which really is another word, as he said, for other things that you might not understand. After market, we get Amazon reporting second quarter earnings. This is the last of the big tech behemoths. Question mark about labor pressure from unions saying, please raise the wages. Pressure also on their cloud computing unit to see how much they are competing. And of course, going forward, any regulatory pressure like what we saw out of Facebook, and that could potentially curb their growth, which is why those shares are lower today in pre-market trading, John.
Lisa, thank you. Here's the quote from Chairman Powell on what has been happening with the bond market. He doesn't know. He says the following: I don't think there's a real consensus on what explains the move between the last meeting and this meeting. Tom, this is what he had to say on the labour market. Let's tee up jobless claims a little bit later. This is what he had to say early in the news conference. I'd say we have some ground to cover on the labour market side. I think we're some ways away from having a substantial progress towards the maximum employment goal. That was kind of the headline in the middle of the news conference, Tom.
It was. There was a shift later. We'll go to that later. But, John, you're absolutely right. And what's great about this debate, folks, is there's a chart that's crystal clear. We're not going to show it now, but there it is, John. Labor participation just isn't back to Valentine's Day, 2 years distant.
Let's get to Luke Carr on that, UBS asset management, asset allocation strategist and former Bloomberg cross-asset reporter. I don't remember him, though, Tom. I just know him from his UBS days. Luke, it's good to see you. You can have a dig back at Tom a little bit later. Let's get to this interview. I want to start with the Federal Reserve and this progress we want to make in the labour market. It's very dependent, highly dependent on how the supply side of this economy responds in the coming months, Luke. What are you and the team looking for?
Well, that supply response is one reason why the kind of sequencing that we need to see is still, as Powell says, a ways off. That, they've highlighted essentially September and Q4 as a time when labor supply might begin to be unlocked, so to speak. So if you're thinking about it from that perspective, well, you just don't get that September data until past September. So some of the more aggressive timelines for signaling the beginning of tapering and perhaps starting that, you have to again kind of push those back a little. And that's why it was pretty useful yesterday to have the ability to mark to market. What are the things that are actually making the Fed more hawkish? Could be down the road. And the only thing they seem to agree on right now is that the labor market needs more healing. Inflation, they're all over the place.
Look, the only reason we let you go to UBS is you took 3 logins and 12 Bloomberg screens with you. And what you use them for is the correlations of the markets. Are these normal markets? Are bonds, FX, all of them, and equities, are they correlated within the asset allocation model?
Well, certainly they're all correlated into varying extents. They're going to paint different pictures about the degree of cyclical strength or not. And right now, what we see in kind of reviewing cross-asset correlations is that on the downside, the assets that are signaling perhaps less optimism about global growth than normal, than on average for this point in the cycle, it's clearly 10-year yields are the standout there. It's quite frankly not even close. And so there is a feeling that you do have to respect the bond market. And as Jay Powell said, he doesn't quite know, so I'm not going to have the hubris to try and define a clear answer there. But you have to respect the bond market, but you can't write it off on the one hand, but on the other hand, you can't let it be the sole author of your asset allocation and what you're seeing out there. So, what we do see out there is still, a fair degree of cyclical strength in things like commodities and in just overall equity prices, and a lot of what you're getting from corporate guidance that does paint a very different picture about the economy we're going to have over the next 6, 12, 18 months than what the bond market is currently signaling.
So what has your change been to the asset allocation recommendation following this earnings season as we wrap it up with the end of its big tech earnings with Amazon later today?
So I would say that there's been no immediate changes, so to speak, regarding asset allocation, but a few themes have stuck out that really do paint just this stark contrast between what executives are telling us and what the bond market is telling us. Because the bond market is essentially telling us we have a very short window for growth before the Fed crushes both right tail inflation outcomes and right tail growth outcomes. And then executives are meanwhile telling us that we seemingly have a pretty long runway for above trend activity to continue. And I would say the biggest thing where we see this, and you might start to get hints of this in the GDP report released later this morning, is just the inventory rebuild process. This is going to be absolutely massive and persistent, and essentially shortages are what are paving the way for having a longer runway for growth, essentially because you need to make the capex to unlock more production downstream. You need more production downstream to meet current demand, and then also to rebuild inventories. And all companies are saying is that we need to do this, but we understand that this is just going to take a very long time. It's so interesting to see companies that have rebuilt inventories to a certain extent are saying that this is our competitive advantage. This is our way we can keep and grow market share and top line, not building inventories as a sign of flagging end demand. So that's something that it inspires a lot of confidence that some of our views on cyclical sectors, whether that be energy or financials or more cyclically oriented markets like Europe, that those are what are going to lead as we move from kind of pricing in this peak growth environment, these kind of quasi fears about how much Delta will delay the full normalization to activity, to what kind of run rate do we settle to on the other side. And that's going to be a pretty strong run rate. We think it's going to be far superior to what we had the early years coming out of the financial crisis.
Luke, final question. How would you characterize your current situation? Are you a happy Manchester United fan or an unhappy Yankees fan? Which one is it?
I'm still a depressed Toronto Maple Leafs fan, first and foremost.
Toronto Maple Leafs fan.
Yeah, but happy about Sancho and Varane.
Tom?
Very happy.
Is that basketball, Tom?
Can we just point out that he has an American flag behind him?
No, is that American football, Tom? No?
No.
They don't know?
It's hockey.
Hockey, okay.
It's
Luke
painful.
Hauer, UBS Asset Management, Asset Allocation Strategist. Luke, thank you. Tom, are you okay? You're a bit disappointed after the Fed decision yesterday, the news conference.
I think it's...
Did you not get what you wanted out of it?
I got what frankly, I thought it was a pretty successful meeting. I thought, to be honest, Chairman Powell started out shaky and he improved as the meeting went through.
He did. He pulled it together slowly, didn't he?
Yeah.
Nice. All right. Up 7 on the S&P. I'll get to the bottom of this. We'll work out what's wrong. Equities up by 0.15%. Yields up by 3, 126.76. You've got a long weekend as well, haven't you?
I'm taking off
You're
tomorrow
off
just to get ready for Ted Lasso.
So I'm just wondering what's wrong.
You haven't watched Ted Lasso yet.
Things.
How can we, John?
I'll watch it.
You've got to watch the first
Tom,
season.
I'll watch it for you. The S&P up 7. It's going to be okay. We're up 0.2%. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The U.S. Senate has voted to move ahead with that infrastructure package. That happened just hours after a bipartisan group of senators and President Biden reached an agreement on a $550 billion spending plan. Lawmakers expect the final passage to last into the weekend and possibly even next week. Now, Fed Chair Jerome Powell says there's still some way to go before the Fed starts reducing massive support for the U.S. economy. Powell spoke to reporters after Fed policymakers kept interest rates near zero. They also maintained their bond buying program. The coronavirus surge is hampering corporate America's plans to get back to normal. Google says it will push back its official office return to mid-October. Plus, workers at its campus will be required to be vaccinated. Lyft is postponing its return date to February. Meanwhile, masks are now required at most of Apple's stores over in the U.S. DD Global is denying a report that it is considering going private. Dow Jones said the ride-hailing giant may go private in order to appease Chinese authorities who have cracked down on the tech sector. The report sent the stock soaring in pre-market trading. Before today, shares of DD were down 37% since it listed on the New York Stock Exchange back in June the 30th. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
estava há um ano sem se apresentar, as escolas estão começando a reabrir, os teatros não vão reabrir tão cedo. Aí a gente teve a ideia, no melhor estilo Minuto do Nascimento, vamos levar a música aonde o povo está.
Minha missão hoje é fazer as pessoas sorrirem, cara. Sorrirem, olharem da janela, verem uma coisa inusitada, ficarem felizes, mandarem pros amigos e, enfim, curtirem um momento diferente, mesmo dentro de casa.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
The biggest debate happening in the business world right now is how to get workers back to work and what benefits to give your employees. Microsoft is asking employees to be back in the office 51% of the time, but you're flexible about the rest of the time. Is that a permanent policy? And for those companies that are saying you have to be back in the office 100% of the time, are they on the wrong side of history?
I think we at Microsoft, we want to be much more data-driven. I also think that in time, if a year from now, we will have more sense of what the real structural change and needs and the expectations of both our employees and our customers are. And we'll really think about long-term policies based on, quite frankly, having all of that data behind us, because otherwise I think we're trying to come up and being too overly dogmatic when I think we need to be more experimental in our approach to return to work, because I do fundamentally believe the world's changed.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
The committee continued to discuss the progress made toward our goals since the committee adopted its asset purchase guidance last December. We also reviewed some considerations around how our asset purchases might be adjusted, including their pace and composition, once economic conditions warrant a change.
Fed Chair Jay Powell there from New York City this morning. Good morning. Alongside Tom Keene and Lisa Brambitz, I'm Jonathan Ferro. Here's the price action in your equity market. A quiet one for the S&P. Futures basically unchanged through much of this morning. Positive 0.2%, up 8 points so far this morning. Outside of that, into the bond market, yields are higher by 3 basis points to 126.43. Tom, euro stronger, approaching 119 again at 118.74. Euro dollar positive 0.24%. And crude, WTI, 72.65, advancing 0.4%.
Two items, John. Dollar weakness, 92.04 on the vanilla DXY, the big nation DXY. And John, a 91 handle there, I think, would be of note. And the other is we haven't mentioned Amazon. We've got important earnings.
A little bit later. And just quickly, Tom, a headline on Citi, reinstating the mask requirement in offices after the CDC update. So one of the updates from one of the banks. And Tom, I do wonder who's going to follow here. Not on the mask mandate, not on that stuff, because that's not being something that they can actually decide on. It's the things that they do have a little bit of flexibility on. Return to office plans. I wonder how flexible they'll be about that, and whether that gets pushed out a little bit more.
We've seen it already, and I agree with you. And John, what I would, if I'm a business, John, I want to get this fixed now. So now is Thursday and Friday.
Well, I'm a business. I'm taking the CDC requirements, Tom. I'm working out what on earth they mean because some people are still struggling with that.
Jennifer Nuzzo doesn't know.
And then I'm looking to apply that. And I agree with you, Tom. Many companies around this country, they just don't know. They're still trying to work that out.
Yeah.
Where they do have flexibility is return to office, return to work, return to the city.
Yeah.
I wonder what the messaging sounds like through the summer now, through August and
Yeah.
into September.
Quickly, John, is it the same in London?
In terms of what, Tom? The mask mandate?
Confusion, just confusion.
No, I think things are just opening up, as you were in London. Not
Okay.
much has changed as those cases really built up.
Okay.
Boris Johnson, the Prime Minister, looking forward and pushing on. And the cases are starting to move in the right direction. That's good.
No, not much has changed in Washington either. Jack Fitzpatrick drives forward the conversation from Anne-Marie Horton in the previous hour. Jack, I guess you had an 18-hour yesterday. What does your day look like today? How can somebody vote against bridges and tunnels?
Well, it's an expensive proposition. This is a $550 billion measure, so you're going to get some Republicans opposing it. But they got 67 votes in favor of the procedural vote yesterday. So really today and the next few days, it's unclear when we're going to see the text. I don't think they have to file the text and put out every detail until at least Friday. But today and the next couple of days, they'll run that by everybody they can run it by in the Senate, make sure everybody who is okay with that first procedural vote is actually planning to vote on passage, and really just trying to wrap up the loose ends. But it does look like this deal is a real deal, and they're just really turning the bullet points into legislative text and going through all those mechanisms of taking the procedural votes.
To Friday, to the Sunday talk shows. Let's even go to Monday morning. Will various and sundry senators know which projects are in that bill?
Probably not. In the near future, I don't think it's going to be very clear. There's a process of earmarking money through authorization bills. So there are some lawmakers who feel confident they'll get funding for particular things they want. But a lot of the money that has been negotiated for this bill is based on formulas. And so then it goes to the executive branch. The executive branch has to figure out the absolute specifics. So what they've been talking about lately is the amounts. How much goes to highways, how much goes to transit. Not every lawmaker, I would guess probably most lawmakers don't know exactly yet how that's going to affect their constituents and might not know for a little while. A lot of this money doesn't go out for a number of years. This is sort of an 8 or the better part of a decade spending plan. So there's still uncertainty in terms of how the politics works for this person's district versus that person's district.
Jack, where is the biggest pushback likely to come from? Republicans or progressive Democrats?
It depends on how it's tied to this next bill. There are Republicans who don't like that this infrastructure bill that Republicans are supposed to like is tied to a $3.5 trillion measure. There are progressives, though, who might not want to vote for this if they think that that next measure is in danger. So it's coming from both sides ideologically for different reasons, because both sides have complaints about how this has or hasn't been tied sufficiently to the next big bill. I know it's a complicated answer, but that's really the challenge going forward is they can't pass this with enough Democrats unless the Democrats get their bill. But the fact that the Democrats are doing that is not popular among Republicans. So there are issues on both ends of this.
It's maybe a complicated answer, but it's exactly where people's minds are. This isn't just a $550 billion plan. This is really a $4.1 trillion package, including the reconciliation bill that I believe Bernie Sanders is working on. Is Senator Sanders close to finishing or releasing bits of what that plan looks like?
Yeah, in the near future, we should see them move ahead with the basic framework. The way they pass these partisan measures without Republican support in the Senate is basically a two-step process. You put out a budget resolution with the basic numbers of what committees are supposed to work on, and then later when they get that bill out itself, you have to vote on the bill as well. So before they leave for their recess at the end of next week, they want to not only have passed this infrastructure bill, but also voted on that budget portion, that first measure to set the stage for that later $3.5 trillion bill. It'll take a while to actually pass a $3.5 trillion bill, but in the near future, the plan for Democrats is to take the vote to set the stage, make sure they can get a majority to vote for that, and get things moving on the even bigger bill.
Jack, thank you, sir. Good to catch up. Bloomberg government reporter down in Washington, D.C. Headline in the last couple of minutes, the masks are back at Citigroup. This from Jenny Saran of the Bloomberg finance team. Citigroup has gone back to requiring employees, regardless of their vaccination status, to don masks when they're in the office. That according to a person familiar with the matter and in line with some of the advisory coming from the CDC this week, Tom.
Well, yeah. I mean, I'm practicing. Is this where
nice.
we're going?
That looks good on you.
It looks good on me.
That is a good look.
I mean, are we ready for this, John? Seriously, is this nation ready for this?
I wonder to what degree this is going to spread, Tom.
I mean,
and I'm not talking about
making a
COVID.
joke.
I'm talking about the decisions. Some companies wait for the advice to come from the CDC. Other companies try and get ahead of it, and they institute even more stringent controls. I think the more important conversation to have away from the masks are the vaccine requirements that we're starting to see come from the federal government and elsewhere, and from private organizations in this country.
Lisa, when's the school debate click in? I'm guessing August 10.
I think it's clicking in right now. When do you start mandating vaccinations? And frankly, it really clicks in when you get children under the age of 12 eligible for the vaccine.
That would be quite a headline if you start to see that date pushed back for the return to school.
Yeah.
I'd be interested to see how this market responded to that. Your equity market right now at 5, advancing a little more than 1/10%. On TV, on radio, this is Bloomberg Surveillance.
week on Bloomberg Green, the rise of green finance.
What we're trying to do is to have a positive impact in every investment and to future-proof those investments.
2021 is the year of sustainable finance, but how do we make sure that all of this money is as green as it's supposed to be?
We know the direction is clear, but the road will be bumpy.
The European Union lays out the green standard for bonds, tightening up rules for banks on climate change.
We see a real link between the impacts a company makes on workers and society and the community, but also on climate and the environment, on the long-term financial value of these companies.
And turning money into motion, the story of how one small activist investor took on an oil giant. I'm Danny Berger in London, and that's what's coming up on this week's edition of Bloomberg Green. Catch it on TV, Quick Take, and online.
Billionaires in space?
What defines going to space?
There is a level where you
It's
get
the common line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing
This
that I
is a
mentioned and you
big
carried on talking
physics
and
thing.
ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio. The curtain will rise again.
Broadway's returning June.
Have you bought tickets?
It's busted out.
You've got more
over.
time here. If you want to.
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Live from New York City for our audience worldwide on TV and radio, good morning. Here is the Thursday morning price action. In the equity market on the S&P, positive a little more than 0.1%. On the NASDAQ, negative 0.2. Some outperformance again on the Russell, the small caps, up 0.9%. Let's frame the week. The debate started with Goldman Sachs and the team over at Goldman with Jan Hansius leading the way. To what degree, to what extent has a full service sector recovery been delayed? And what does it mean for the economy? What does it mean for this market? So let's work through it together. In the bond market, switch up the board, 2s, 10s and 30s. Your 10-year right now, 125.59. I don't know why we're down here. There's no consensus on why we're down here. Chairman Powell doesn't know why we're down here. But let me tell you, if we don't get that supply-side response in this economy anytime soon, it's going to get much, much harder to call this bond market and to call this labor market. And Tom, that's where I want to finish. In the labor market, switch up the board and get to the employment to population ratio in America. You can take a chart of this, you can take a chart of the participation rate, you will have a gap lower, you will have a little bit of improvement, and then it will stall. And Tom, what we need to see in this country is a supply-side response on several fronts. And what many people anticipated is for that to start to develop in September and heal as the year grows older. The issue people have now, Tom, given the developments on the COVID side of things, has that been delayed? And to what degree?
And on radio, all you need to know is we're 60% back to where we were. John, I'd suggest 7 million jobs. I think time has to move on, John. All of this has happened very quickly, and the real COVID setback that we've got right now, we're all impatient for Q2 of next year.
We need time, Tom, but it's not a demand problem, is it?
No.
So what's the Fed's role in all of this?
That's open to debate.
That's going to be the interesting conversation for the next several meetings. What is their role in all of this? And is the taper debate, is that exclusive? Is that the same story as what's happening in this?
I don't
think it is.
Yeah, my enthusiasm for the private enterprise of America, from the big companies like Amazon, right on down to small businesses, John, that's what I'd focus on.
Just pushing things out, just a little bit.
Just pushing
it out. And Lisa's right to keep bringing up the school issue as well, because September is absolutely crucial. Some of the things we're talking about through the week, we'll keep talking about them through this program. Let's get you some movers and bring in Romain. Hey, Romain.
Hey, good morning, John. Let's focus in on the transportation sector this morning here. Uber shares taking a leg down. Of course, that report out of Bloomberg that SoftBank is actually shopping $2 billion worth of shares over at Goldman Sachs between 44 and 46 bucks a share. That report is out of Bloomberg. There's a separate report by one of our competitors over at CNBC saying that they were specifically shopping those shares to cover losses on DiDi. Of course, we know DiDi shares were down about 50% prior to the last couple of days. Those shares did rally to 10% yesterday, and they're up about 17% here in the pre-market. Of course, on another Bloomberg report saying that that company might be considering going private. DiDi saying that's not true, but nevertheless, some of the dip buyers jumping in here just in case here. Also in the transportation sector, a completely different story, and that's Ford. We did get earnings out of the company last night. They were pretty good here, a surprise profit. The concern here is they are losing market share. Market share in the U.S. right now down below 11%. Remember, it was at about 15% a year ago. But Tom, they got a huge pipeline coming. All those electric vehicles, I know you had your eye on an electric Ford Mustang, an electric, what was it, the F-150 Lightning. All that is in the pipeline, and the company saying some of the supply chain issues, they're working through it. Don't worry, those 2022 models, they will be on the lot sometime this year. You might be able to get your hands on one, Tom. Flip up the board here, just a couple other quick names that I want to take you through here. Let's look at Qualcomm here. We did get those results. The company saying that it is also dealing with those supply chain issues, and it's managing to diversify away from just the smartphones. Remember, this is a company that has really sort of risen and fallen based on the smartphone cycle. It said it's managed to move into consumer electronics and a lot of networking gear. Investors seem to like what they hear. They did not like what they heard out of Facebook yesterday, despite 56% revenue growth and a doubling in net income. That company saying that's not going to last. It cited regulatory headwinds and, of course, those new restrictions by Apple on its platform to restrict how data is collected. Those shares down 3.5%. Those were all the big stories over the last 12 hours. In about 8 hours or so, we are going to get Amazon, of course, the big granddaddy out there, fourth largest company in the world, knocking on the door right now of a $2 trillion market cap. Stay tuned for that later tonight, Tom.
Romaine, thank you so much. John Farrell, the movers of the Romaine Bostic. John, is Harry Kane a mover? I still can't figure it out.
Don't know yet, Tom.
Is he going to leave from the Tots and go someplace else?
I think that would be the big signing of the transfer window for Spurs if they hold on to him. Do you want the real breaking news? Just to reiterate, Tom and I don't drive. Tom and I don't drive.
That's breaking news.
There's only one person on this team that drives, and it's Lisa.
Yeah,
correct. It's not Tom and me.
Yeah, I don't know how else you would get up to Tupper Lake.
Exactly.
We'll have to discuss that.
I know. We need to work this out. What we're waiting for, Lisa, is that fully autonomous driving vehicle to come along and just
I don't buy it. Oh, John, I don't. You're going to get me going, John.
Fully autonomous. We'll have a subscription, Tom.
I saw a Tesla article the other day. John,
rolls up.
I saw a Tesla article the other day that the auto driving thing got screwed up because of a yellow traffic light.
Really?
Yeah, seriously.
Yeah, that's not good.
That's not good.
We need some progress,
Guys,
Tom.
Here's
then we
what's
can have
good.
a subscription.
It's not that hard to drive.
David Rosenberg with us the last hour. Let's keep going. David Rosenberg. My word, you sounded like Tom King. David Rosenberg, the last hour. Michael Schumacher joins now, and he is Cornell Big Red, and he knows Liner Rink is where they play good hockey, and he throws it into his note this morning. Michael Schumacher, long ago and far away, there was a CCM 5-stripe. That's a stick that rich kids had, and you say this is a yield that's going to look like a CCM 5-stripe hockey stick. Discuss that, the Nirvana out to a higher yield.
Yeah, Tom, especially when you consider the idea of real yields in the U.S. being minus 115, 120, some crazy number in 10 years, it makes very little sense. Real yields at this negative level are remarkably unusual. It's happened only a couple times. The last time was just before the taper tantrum. And you've got to ask yourself, what is the economic backdrop today versus 12 months ago? Substantially better. We can talk about COVID case counts going up recently, et cetera, but still, it's pretty hard to dispute that things look a lot better now than they did then. Yet yields are much more negative in real space. And we think this is a bit crazy, frankly. So when you've got high inflation, it should push up nominal yields. Real yields probably follow suit. We think the stage is set for yields to climb. However, I've said that before on this show, and in the last couple times it's been wrong. So I think a little humility is in order. We think it's going to take a while, probably 3 to 4 months for this move to get in train. I think it's probably a November, December type of scenario.
To understand why they're going to go higher, Mike, I need to understand why they went lower in the first place. Why did they, Mike?
Yeah, a bunch of things came together, John. And in fact, yesterday is a good example. So why did yields drop in the last hour or two of trading yesterday? Well, one of these arcane things, we think it was tips investors adding duration before month end, which is tomorrow. So not the sort of thing you necessarily tie to a Fed meeting, but it did crop up. But I suspect the bigger thing going back to the June Fed meeting is the Fed really gave the green light for people. They said, look, we're not going to do anything for a while. We'll sit here. Maybe we'll put a mention of taper in the statement, that sort of thing. But we won't actually really change policy for quite some time. So a lot of investors out there look at the yield backdrop and say, well, it's super low. I have to do something. I've got to pick up a few pennies in front of the steamroller. What can I do? I can move out. I can buy longer maturity, longer duration bonds. Maybe I can sell some options, that sort of thing. But the Fed really put that back in play in June. And we think that was perhaps the big driver. On top of that, you've got overseas flows, which have been pretty strong.
Mike, one thing that always confuses me and I'm a little bit uncomfortable with is when people take the price of the bond market and say, this is what the market is looking for, inflation at X% over whatever time period. Mike, I'm uncomfortable with that because some people buy inflation protection, not with conviction, but as a hedge. And I just wonder, Mike, whether we misread what markets are actually telling us behind the motives of the people making these decisions.
I think another way to consider that, John, is does the inflation market that we trade, so tips, swaps, et cetera, is that really predictive of future inflation? I would say not very well. I think you make a good point that quite a few investors and other players out there buy inflation protection because they need to, not because they want to. It's probably the case again. But still, in terms of short-term market dynamics, it can have a fairly big effect. I think another way, too, to consider this question is, do forward rates in nominals really predict future actual yields? And the answer consistently from academic after academic has been no. And if we take that analysis today, the forward 10-year Treasury rate at year end is about 140. Does anyone really think that's a great predictor of where it'll be? I would say not.
So what do we have to see? What's the trigger to get real yields less negative, off their lowest levels ever seen?
At least I think a few things have to come together. Probably even more strength out of the labor market. Thinking about some of the comments that Chair Powell made yesterday, very few specifics, a lot of generalities, but one theme that came through is more and more strength out of the labor market. There's been a lot of concern, speculation, hope perhaps that come September, maybe October, the labor market would be much stronger in the U.S. than it has been. If that happens, that probably pushes yields up quite a bit. If instead we get a reaction where the COVID case counts have worsened, Delta seems to be becoming almost endemic, that scares a lot of people, that keeps yields pretty low. So I think the tipping point, my colleagues on the Wells Fargo economics team would share this view as well, is going out 2 to 3 months. Do you really get a break? Does that supply chain really start to move? Does the labor market clear up?
That's the key question, Mike, for everyone right now. Mike Schumacher, Wells Fargo Global Head of Macro Strategy. Your real yield on a 10-year, negative 1.17. And just briefly, Tom, after rolling over quite aggressively over the last couple of months, gold's starting to wake up just a little bit. Just a little bit. We're starting to see some movement in gold in a way that we didn't, say, going into June.
Up $30, 1832. It is a little bit of a breakdown, and we heard from Jack Ablin from Chicago and Crescent, his affection for tangible assets. That would be gold.
Gold off the back of real yields, negative, Lisa, 117 on a 10-year.
It actually could make sense from the point of view, and just talking about negative real yields and how negative they are. I spent a lot of time yesterday thinking about this. And if the Fed's going to keep printing money, if they're basically going to keep injecting cash into the financial system after surging, after the balance sheets basically doubled since the beginning of 2020 to more than $8 trillion, you have to think, where is that money going? And if it can't go into things and services, it's going to go into assets, and a big asset, treasuries. This is really it. And I think that I don't really see what's going to change that dynamic.
Tom?
The 5-year inflation-adjusted yield, John, are we mentally ready for Dow 10,000, which would be a negative 2% yield?
Did you just mention the Dow?
No, but like a benchmark. The Dow is a benchmark.
Just threw me there.
The Dow is the soul of the nation.
Is it?
Dow 10,000. So you've got real yield, negative 2% yield. That's like equivalent to Dow 10,000.
The S&P 500's up 4, advancing 0.1% up next. In the next Dow.
Negative 1.97.
Deutsche Bank chief U.S. economist.
Luzetti looks at the Dow.
I bet he doesn't. From New York, this is Bloomberg.
With the First Word News, I'm Leanne Gerrans. That $550 billion infrastructure passage has cleared its first barrier on Capitol Hill. The Senate voted to begin consideration of the bill. 17 Republicans joined all Senate Democrats and 2 independents in voting for the measure. Lawmakers expect the final passage to last into the weekend and possibly even next week. The new chair of the Federal Trade Commission is vowing to return the agency's trust-busting roots. Lena Khan told reporters she intends to use the FTC's full arsenal to take on companies that are preventing competition. Khan also signaled she's not afraid to take on risky cases that officials have shied away from in the past. China may be preparing for a period of prolonged tension with Washington. Beijing's new ambassador to the U.S. is a veteran diplomat known for pushing back against Western criticism. Chen Gang most recently served as vice foreign minister. He told reporters he would work to put U.S.-China relations back on track. And it's one of the most anticipated listings this year. Robinhood raised $2.1 billion in an IPO priced at the low end of the marketed range. That gives the trading app company a market value of just under $32 billion. Robinhood shares began trading today. Now, pro basketball star Kyrie Irving has some harsh words for Nike, which makes his signature sneaker. The Brooklyn Nets player said on Instagram that the latest version of his shoe is trash and that he had nothing to do with its design or marketing. He also said Nike plans to release the shoe without his okay. No comment yet from the company. Global news 24 hours a day, on air and on Bloomberg Quick Take. I'm Leanne Gerrans. This is Bloomberg.
surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
We can come together to help less developed, fragile, vulnerable countries with adaptation and resilience, and we can do what we developed world need to do to reduce the damage being done by our practices of the way we produce energy.
But how likely is it that we keep that 1.5 degrees within reach?
Well, look, the Paris Agreement said well below 2 degrees. That's what everybody signed on to. What is well below? It's certainly not 1.9 or 1.8. It's somewhere close to the 1.5 degrees. And so I think it's very important to do it because every decimal point of rise in temperature is remarkably compounded in the damage that it does. We're at 1.2 degrees today, and you see what's happening. Imagine what happens when you're at 3 degrees or so, which is the track that we are currently on.
But fundamentally, the only way to solve this problem is that we need to make more semiconductors in America.
Good to catch up with Gina Raimondo there, the U.S. Commerce Secretary from New York City this morning. Good morning. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Here's the price action this Thursday morning as we wait for jobless claims in America about 42 minutes away. Equity futures up 6, advancing a little more than 0.1%. Yields higher by 2 or 3 basis points to 126 on 10s. The euro stronger, euro dollar 118.74. Euro dollar positive 0.2%. Call it positive 0.25%. Crude oil, WTI 72.79. Switch up the board. This just for you, Tom Keene. Drum roll. DD Global 1037 up by 17%. This one surged by 40% after the Wall Street Journal, Dow Jones, Tom, reported that this company was considering going private, and then the company itself denied it, and we rolled over hard, Tom.
Cian Shen for Bloomberg summarizing the story right now. DD shares surge on report is considering going private. And then Cian goes on to try to unravel all that's going on.
That's it. We don't have to do anything else. We're done. It's good.
No, well, I don't know.
I know you don't want to cover this story.
I don't know. I mean, I know it's an Amazon equivalent, but that's where we are.
I think it's interesting.
Thanks, Lisa.
Anytime. Carry on, Tom.
David Wilson here to save us. A little spat within the family. David Wilson, always cheerful on growth and value, but with a geographic bent this morning. David, save us.
Oh, well, I'll do my best, Tom. Drew Dixon over at Albert Bridge Capital looked at U.S. versus Europe in terms of valuation, specifically forward price earnings ratio. So looking out 12 months.
Interesting.
And what he did was he broke down, the U.S. and Europe into growth and value using the Russell 1000 index for the U.S. and the Eurostoxx total market index for Europe. And when you run the numbers, you find out that growth stocks here in the U.S. and in Europe are pretty much the same in terms of their valuation based on forward PEs. The disparity and the reason why U.S. stocks, historically have been more expensive than European shares arguably comes down to what's happening on the value side of the equation. Something like 18 times projected profit for the Russell 1000 value index. Look at its Eurostoxx counterpart, it's more like 12 times. So in other words, you've got about a 50% gap between the two, and that in large measure explains why this disparity in valuation exists.
You and I have talked, that's beautiful. You and I is really, really important, folks. You and I have talked about this. Value always needs a catalyst. What's the value catalyst to get cheap Europe up to that 18 multiple?
Well, that's the challenge, is what's going to turn things around, because, you look at the bigger picture. I mean, the U.S. economy has been growing faster than the European economy. You still have the disparity in terms of the coronavirus out there. So there are a lot of reasons why this exists, but it's persisted over time. Whereas if you look at the growth stocks, I mean, the valuations have kind of come into range with each other, more recently, really this year.
So how much does this matter if the backdrop is really driven by monetary policy, by the shift in Delta variants? I mean, basically, how predictive have these metrics been?
Well, mean, there's no doubt it's part of the mix. I mean, all you have to do is look at this year's performance for growth and value on both sides of the Atlantic. You can sort of see that. I mean, that's really the issue as much as anything. You know, people are kind of recognizing what's going on. And, you know, as Dixon put it, you know, investors are thoroughly discarding European value. That's been the issue, and it's why the gap is what it is when it comes to these forward PE ratios.
All right, Dave, I want to shift gears a little bit because Tom Keene's been sending messages all morning saying we need to do more DD. And this really, to me, is one of the most important stories of the day, especially in light of the turmoil that we've seen in the Chinese stocks. John raised a point earlier today saying that this has renewed significance because investors in the United States and Europe are looking at the likes of DD as part of a subset of ride-sharing companies, and that basically this becomes a part of a basket of companies that people invest in. If its shares plunge or if they rise, there is a contagion mechanism within that. Are we seeing that? What are you hearing from investors on that point?
Well, I mean, one thing you can say definitely is that there's a link in terms of Didi and Uber, and I say that because, you know, late yesterday, you know, we reported Goldman Sachs had put up a block of 2.1 million shares of Uber. And CNBC then reported that it was sold by Japan's SoftBank to offset a loss on its stake in Didi. So when you put it together, there's certainly that relationship. I mean, it's not like you have enough ride-hailing companies necessarily for a big global basket, but there is a relationship between them as represented by what appears to be that SoftBank
It's
sale.
a huge value add. David Wilson, thank you so much. And John Farrow, what David brings up there, and you know, I've talked about this, I'm sorry that Western banks are all involved in these discussions.
Oh, absolutely. And on Dave's point, I think it's really important. The SoftBank Uber point, you don't sound what you want in these moments, you sound what you can. I've learned a ton from Mohamed Al-Erin over the years, and he reflects on his time, Tom, in emerging markets and his time at the IMF as well, where he'd go to investors and ask them about something that was happening in Mexico, and they'd say, yeah, we're selling Chile. And he'd turn around and say, what? Why are you doing that? And they would say, look, we've already taken the hit on something like Mexico. Chile's still doing okay, that's next. And that's the problem that people have. It's the contagion risk, Tom, and then the company's trying to get ahead of the contagion risk, and this can snowball pretty quickly. I don't think we've seen the end of this yet. I know a lot of people in fixed income who are super focused on Asian credit off the back of the property market in China and how this starts to bleed, Tom. It's just the beginning. Keep an eye on it. Keep focused on Asia credit, see what's happening, and keep your eye on how this spreads, the contagion mechanism for something like this that starts very idiosyncratic, Tom, and then starts to bleed out.
Lisa, that's on the edge of gloomy as you. That was the pendulum of snowballs. I mean, you know, he sounded like you for a moment.
Do I sound like you? Honestly,
Pendulum
listen, I think that just
of
sounds like a
snowballs.
rational approach to what we're seeing over in China. I mean, the regulatory risk is a big black box. We don't know what the Chinese authorities' tolerance to a sell-off in equity markets really is. And thus, you don't really understand also the interconnectivity of this market, especially as people seek to diversify in a low-yield world. I mean, you do have to think that there will be some trickle-out effect, and it could be significant if it's prolonged.
Third biggest weighting in emerging markets index on the MSCI, Alibaba.
Fair.
Number 2, Tencent, 5%. Those two names, 10%. You can go through the list, Tom.
No,
that index has changed a lot over the last few years.
Oh, more than a few years. This is a really important point, John, how EM visibility and the mix of EM has really changed from the certitude we had 15 years ago. John, what I would suggest is the compounding yield on the triple leveraged all cash fund, it's snowballing.
How's that doing?
It's snowballing.
I'm not saying this is going to explode. I'm just saying they're the kind of things that people are looking at right now for a sign that this is starting to bleed out. That's all.
Can I just say you think that I'm the gloomy one? I'm not the one in all triple leverage all cash. I mean, the pendulum of triple leverage all cash. That's a pretty bearish one, I got to say.
Risk averse around a table.
There you go. And you don't even drive.
No,
neither do I, Lisa.
Fair.
It was like 3 different judges in 3 different courts said I had to be in triple leverage all cash.
Jeffrey Yu, BNY Mellon senior strategist, joining us shortly from New York City. Your equity market up 6, +6, and advancing a little more than 1/10 of 1%. 126 on 10s, yields higher by 2 or 3 basis points. Heard on radio, seen on TV. For our audience worldwide, this is Bloomberg Surveillance.
Blast off. China's first manned mission in 5 years is on its way. 2 veteran astronauts and 1 newbie are making their way to Tianyi Space Station, which means heavenly harmony. They're travelling in the Shenzhou 12 spaceship, launched by a Long Mark 2F Y12 rocket.
我们一定服从命令，听从指挥，沉着冷静，精心操作，圆满完成神舟12号载人飞行任务。
The crew members will be staying at the station for 3 months. They'll be carrying out experiments, testing equipment, maintenance and more.
2022年完成空间站的在轨建造，建成国家太空实验室。之后，空间站将进入到应用与发展阶段。
Once completed, the space station will allow for stays of up to 6 months, just like the International Space Station. China has big ambitions for its space program. Last month, it landed a probe on Mars that carried a rover, the Zhurong. It sent 11 astronauts into space and 2 years ago sent the first spacecraft to land on the far side of the moon.
Up to Maine and had a lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astracoma carinata.
I nailed it.
It's not thera, whatever. Astracoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
Bloomberg has enhanced search on the terminal to deliver what you need when you need it. Now, you can simply type phrases in everyday English in the command line. Compare financials. Find people. Analyze markets. You can enter phrases or ask questions. What do you want to know today? Ask a question or visit SearchGo to find answers now.
Unless they want to start buying equities or, putting on cheerleader outfits, I'm not sure that the Fed's going to stand by.
Some of the more aggressive timelines for signaling the beginning of tapering and perhaps starting that, you have to, again, kind of push those back a little.
Monetary policy cannot combat the major problem to the economy.
We've shown that if you give enough fiscal stimulus, you can get a strong economy.
Having some cash to deploy and look opportunistically for sell-offs is a good idea.
This is Bloomberg Surveillance with Tom Keene, Jonathan Farrow, and Lisa Abramowitz.
Good morning, everyone. Jonathan Farrow, Lisa Abramowitz, and Tom Keene, a simulcast, Bloomberg Radio, Bloomberg at television after the Fed meeting, and we move right back into markets signaling whatever your view is. John, as we heard in the opening there's a few views out there.
I like that, Tom. Markets signaling whatever your view is. Next stop, payrolls. And payrolls, we're looking for a big one, something close to 1 million. We need to see a few months of that to set us up for the taper debate. As Bank of America put it, Tom, progress on progress. And I'd add progress on progress towards substantial further progress towards their goals.
There's a headline right now which changes the dialogue in Europe. This is the Bundesbank fear, John. I know your terminal's a little slower than mine. German inflation rate rises to 3.1% above the estimate of 2.9%. That's the angst of the inflationistas, isn't it?
Yeah, very different to the angst over here, though, Tom. And if they start complaining, they're whistling in the wind. Just look at the forecast from the ECB for the next couple of years.
Exactly.
CPI, 190 this year, 150 next year, 140 2023, 1.4% 2023. The German central bank's going to have a tough time arguing the doves over to their side.
On radio and TV, we're going to truncate our opening this morning to get to Jeff Yu as fast as we can. Lisa, your observation on Chairman Powell, was he successful?
He was successful in doing nothing in terms of the market, and he was also successful in signaling that they are going to start talking about the taper debate. However, very confusing in terms of the bond market's response, what the bond market will look like, and frankly, what actually means substantial further progress other than some huge jobs numbers in the next couple of months.
John, review Didi this morning, just as we go to Jeff Yu here on China. I think it's important.
Sure.
Review what is
version.
going on with Dai.
Dow Jones out this morning saying perhaps they'd go private, stock up a lot. Then Reuters comes out and says, company says no. Company itself says no. This rumor is not true. Stock rolls over. Still positive, Tom, by 16%. IPO price was 14, trades now in the pre-market at 10.29. That's basically the story after a big clampdown in China. And still on this name specifically, we don't know, Tom, enough information about what this company knew before it went public and what they failed to disclose to investors. We still haven't got clear answers to that. This story's not over.
The movable feast here, folks, is the market reaction and maybe some of the childish interpretation into very sophisticated political economics. Jeffrey Yu has made a career of this at BNY Mellon as their senior strategist. John, why don't you bring in Jeffrey Yu with his perspective synthesizing all this together for Beijing?
Jeff Yu joining us now from BNY Mellon, the senior strategist. Jeff, as always, you're going to be super helpful working your way through this issue for us all. Walk me through what we need to pay attention to and what is worth ignoring.
Right. So firstly, pay attention to differentiation. What you're seeing with individual companies in China, in terms of individual sectors, the regulatory crackdown, there are different motivations behind it. Some have to do with international capital involvement, especially in the education sector. So, for example, they've stressed there's so much money pouring into an arms race amongst Chinese families to get their kids ahead. It's seen as damaging, so they want to treat this on an individual basis. Now, the second part of it is this framework of international investors investing in China. How should it be done? Should it be in the US? Should it be closer to China? That is something they're going to be looking at as well. And here's where geopolitics can come into the fray. Thirdly, and most importantly, I think what people are missing right now, we're talking too much about the equity market right now. We're talking too much about individual companies. What about the growth environment? No one's talked about the RRR cut that has happened and more that may come. No one's talking about the Delta variant starting to spread in multiple provinces and municipalities in China. Growth expectations are coming off. And this is what we need to be attuned to heading into the second half of the year.
Let's build on that, Jeff. The degree to which the issues in the property market now are linked to perhaps a downgrade to the outlook on the Chinese economy.
So two things here. Firstly, let's stick with property now. So any day now, normally it comes out around the end of July, early August, we get the 2021 Financial Stability Report from the PBOC. This is a brilliant report, and they look and they do stress test the entire banking system. Last year's numbers, right? If you have a 15 percentage point rise in property NPLs, and amongst other scenarios, you can see capital adequacy ratios within Chinese banks go from 15% down to below 10, below the regulatory limit, right? So this is how important this is for the sector. Individual companies, they're looking at exposures as well. Is it manageable? Yes. Is it systemic? Probably not at this point, but the damage to wealth, the damage to consumer expectations and households, that will drive growth lower as well.
I look at, Jeff Yu, where we are in this. It's not a crisis, but this moment for China, this moment for the Pacific Rim. And the elephant in the room is we don't have Hong Kong anymore. It's a different Hong Kong. How do you perceive, Jeff, the Western banks, and I don't want you to speak for the management of BNY Mellon, but how do the Western banks adapt and adjust now that Hong Kong is different?
Well, they would adapt to looking at China as a whole and the new avenues of opportunities, right? Look at what the 5-year plan detailed. It was very explicit, welcoming foreign investment into China's industries, welcoming foreign talent to drive China's quest for self-reliance, right? So China knows it cannot grow by itself. It's going to need external expertise as well. But at the end of the day, it has to be done in a way which is manageable and does not introduce systemic risk or other risk. So going back to the education issue, for example, this is not a financial systemic risk or anything like that. It's something that's more social, and in the prism of falling birth rates and demographics, that is a serious challenge. So if foreign investment facilitated by the financial institutions, if it's seen as broadly damaging, then like any regulator globally, it's not a China-specific issue. They probably want to do something about it. It's growing pains for Wall Street and for everyone. And I think as China develops and integrates itself with the rest of the world financially, we have more index inclusion, CGBs increasing ownership. All of this is going to happen. Just calibrate it, pick the right pace, because sometimes, things, even with good intentions, you can actually end up with bad outcomes.
Jeff, this is one reason why a number of investors said that, in particular, the education sector in China, but including other shares as well, were uninvestable following a number of regulatory crackdowns over the weekend and Monday. The idea that it wasn't just education, it was also the data and the control over such things in the country. Given the pushback, the fact that authorities did have meetings with banking executives to try to push back some of this concern and shore up support for the markets, do we have a sense of how far or not they are willing to go with crackdowns, with restrictions in specific industries that could further roil markets?
So I think China is learning as well, like any regulator. This is a new environment for China. They've realized how invested in the international community is in certain sectors, right? So again, education and being one of them. So they wanted to gauge the market fallout. And if it has become excessive, and you saw the three-pronged launch from the main financial papers in China yesterday, stressing that over the medium to longer term, China is a strong market, welcoming global investors to there. So, of course, they don't want to damage sentiment either. They know how interlinked it is, and the country needs to stay interlinked. So they will learn as well from this, and as future sectors go by, maybe they'll do it differently as well. But just pay attention to the strategic initiatives. They want to communicate them better up ahead. By the way, something similar happened a few years ago to the childcare sector. Exactly the same language. Not allowed to make profit and not allowed to use capital markets to raise money. They wanted to smash the nationalized framework. It seems we all forgot about that. So this has happened again. And again, they're learning by doing, as we all are right now.
Jeff, let's put some money to work. We spent a long time talking about the risks, the framework for thinking about the situation. Where do you want to put capital to work, considering everything you've just said in the last 7 minutes?
Right. So three things here. Firstly, on renminbi, I still think renminbi trades a range, and ignoring all of the current news right now, they are worried about CPI and the PPI divergence, right? So exports are still very important. So they wanted to limit renminbi appreciation anyway. So the recent moves over the last few days, and probably it's not unwelcome. In Europe, I think what the ECB has done, very good for European equities. I think those trades and where people invest in European equities on a hedge basis, I think that will work as well by anchoring expectations. And finally, the US and the dollar, we're not ready to call time on the dollar strength yet, not by any means. It's still going to lead the way in major policy renewal and normalization. So these carry trades, you want to own dollar carry against the low yielders, especially in Asia, and some of the high yielders, I think they're going to falter against the dollar as well.
Jeff, interesting stuff. Jeff Yu of BNY Mellon, a strategist I've known from London, Tom, for a long, long time, and one of the sharpest in the city, that's for sure.
It's that LSE education. I mean, he synthesizes things. So, folks, this is something that we try to do with all our different guests. It's just one thing to be an expert in whatever, but John, as you mentioned, the ability to synthesize, it's really important.
And not giving up on that dollar call. Lisa, right now, dollar index 92.
A lot of people saying that, frankly, the Fed has to be the first mover when it comes to raising rates among the big developed market banks. And as a result, what's going to pressure the dollar weaker?
That's the issue, isn't it? Well, you'd think synchronized global growth. That was the call at the start of the year, right? Let's frame the year. We came into 21. We were looking for global synchronized growth, which naturally we all thought would engineer a weaker dollar. That was a consensus view, Tom. Played out for 5 minutes. Euro dollar topped in the first week of this year, with a 123 handle.
Okay, but that's where I wanted to go, and we haven't gone there this morning because we're spending too much time, looking at the DD news up and down. John, given the new milieu for Madame Lagarde and the rest, is that angst of a 125 euro? Is that new angst at 122?
No idea. We're not there yet, though, are we?
No.
Where are we now? 118? Not even 119. Things can change quickly, but that's not been a concern of theirs for a while, Tom. They've got much bigger concerns.
That's
the FX channel alone is not going to solve this for them.
Or for China.
They've got a 2-year forecast at the ECB, Tom, of inflation coming back down to 1.4. I don't want to get in the business of arguing over 50 basis points. I'll let the central bankers do that. But, Tom, the ECB president itself is clearly not happy with that.
Yeah, well, same with renminbi in China. Yuan's not going to fix it for China.
Coming up, Bill Dudley, Bloomberg opinion columnist and former Federal Reserve Bank of New York president. Don't miss that conversation. It's just around the corner. Your equity market up 9, advancing 0.2%. Heard on radio, seen on TV. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. The US Senate has voted to move ahead with that infrastructure package. That happened just hours after a bipartisan group of senators and President Joe Biden reached an agreement on a $550 billion spending plan. Lawmakers expect the final passage to last into the weekend and possibly even next week. Meanwhile, senators are looking at cryptocurrency taxes as a way to help fund the infrastructure plan. The proposal would impose more rules on crypto brokers to report transactions of digital assets to the Internal Revenue Service. A summary of the plan says it will raise additional $28 billion. Now, the coronavirus surge is hampering corporate America's plans to get back to normal. Google says it will push back its official office return to mid-October, plus workers at its campus will be required to be vaccinated. Lyft is postponing its return date to February. Meanwhile, masks are now required at most of Apple stores over in the US. It was one of the most anticipated listings this year. Robinhood raised $2.1 billion in an IPO priced at the low end of the marketed range. That gives the trading app company a marketed value of just under $32 billion. Robinhood shares begin trading today. Citigroup's Asia Pacific Wealth Management Unit just posted one of its strongest half years on record. Citi attracted close to $15 billion in net new money across the region in the first 6 months of 2021. The bank has added several hundred wealth professionals in Hong Kong and in Singapore this year. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120 countries. I'm Leanne Gerrans. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
If inflation did seem to be persistent, the Fed wouldn't hesitate to act, and that you have the tools to deal with inflation. What do you say to critics on Wall Street who say, yes, you have the tool to deal with inflation, you raise interest rates, and then historically plunge the economy into recession?
Yeah, that's exactly the kind of logic, I think, that you want to avoid, that you get too far out of alignment with what's actually happening in the economy, and then you really have to react more strongly than you'd like, and possibly causing disruption in the economy. So you don't want to be in that situation. I think the risk management here is that if inflation does come back down in 2022, we're in great position for that. We're exactly positioned for that. But if it doesn't, we're not in such great position. So I think for that reason, we want to have some flexibility on this taper.
Billionaires cars in space?
What defines going to space?
There is a level where you
It's
get...
the common line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around, and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing that I mentioned and you carried on talking and ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio.
I'm David Weston. Bloomberg Television is reinventing one of the most iconic brands in financial television for a new audience. Join me to see the news program for the clever investor. This is Bloomberg Wall Street Week.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield.
I actually have enough confidence in the market that most of these bottlenecks will be overcome. You know, you saw that in the case of timber prices. It went way up and then came way down. Is there any fundamental reason that we should expect this to be other than transitory? And I think the answer is no, and I think that's where the IMF is, that's where the Fed is.
That was Joseph Stiglitz there, the Columbia University economics professor from New York City this morning. Good morning. Alongside Tom Keene and Lisa Bravitz, I'm Jonathan Ferro. Equity futures +8, Tom advancing about 0.2% on the S&P 500 this morning.
If you want to clear up, John, you can go to Wikipedia and you can see the theory that the pros use off of what Chairman Powell wrote yesterday. One of those expert on the theory is a gentleman from Berkeley. William Dudley joins us, the former president of the New York Fed, obviously for years at Goldman Sachs. Bill Dudley, you separate the men from the boys, the women from the girls, with the logic theory of necessary and sufficiency in an undergraduate class. You speak of the necessary and the sufficiency that we saw yesterday from Chairman Powell. What did he do that you say was not sufficient?
Well, I think that he did a good job in basically edging closer to the notion of we're going to start do the taper, but not so much so that it puts the markets on edge. The general expectation at this point is Fed probably won't start tapering, probably won't make the announcement of tapering until November or December, and probably won't start until early next year. So I think he did a good job on that. Where I would say the Fed hasn't gone far enough is the changes that they've made in terms of their standing repo facility that they announced yesterday. It's a good start to have a standing repo facility that backstop the Treasury market, but they capped its size at $500 billion, and they limited access to only primary dealers. And I think the access should be considerably broader than that to support the functioning of the Treasury market. Also, I think they need to make changes to their capital requirements so that when the Fed buys Treasuries and agency mortgage-backed securities, and that increases reserves in the banking system, that doesn't interfere with good market functioning in the Treasury market.
These are delicate phrases, and we appreciate the candidacy as a former government official. Bill Dudley, we have the overnight repo market now moving back up through $1 trillion. Let's cut to the chase here. If the overnight goes near $1 trillion, above $1 trillion, how will the Fed adapt and adjust to that?
There's no magic number that where if the Fed is soaking up $1 trillion of repo through their reverse overnight repo facility, that's not a problem. But I think it does tell you that there are consequences of the Fed's asset purchases. The banking system is essentially awash in reserves, and that's making the leverage ratio more binding, which is constraining banks' activities, and it's also causing banks to essentially push away corporate deposits. The Fed could fix this by making changes to how the leverage ratio is calculated, and I think they should do this sooner rather than later.
Is the Treasury market as it is now broken?
No, I don't think it's broken. It just needs a little bit more belt and suspenders. The standing repo facility is a good start, but as a Group of 30 report was published yesterday points out, there's a lot of other things that need to be done to the U.S. Treasury market. The G30 report talks about central clearing of treasuries, for customer trades. That would make the market, I think, a lot more solid. It talks about increasing the transparency in the U.S. Treasury market. So having a standing repo facility is a good start, but there's a lot more to put the U.S. Treasury market on a firmer footing.
This may sound esoteric. It is not. It is the underpinning of what we pay for all of the loans that we take out is the underpinning, frankly, the functioning of Wall Street. And there is a question about the functioning of the Treasury yield as an indicator right now. Even Fed Chair Powell came out and said he didn't quite understand why yields were where they were. And a lot of analysts have raised the issue of liquidity, the fact that there are these malfunctioning aspects of the bond market that made it very difficult to get a clear signal from treasuries. Do you think that that is a factor in yields that are persistently low given the inflationary outlook?
Well, I'm surprised by how low long-dated treasury yields are given the level of inflation, the fact the economy is in recovery mode, and the fact the Fed has said that they're going to be very, very patient before they actually raise short-term interest rates. In that environment, you would think treasury yields would be higher. I think what's really happening is quantitative easing is very, very powerful. As the Federal Reserve buys more and more assets, that creates deposits in the banking system that people don't want to hold. And as they don't want to hold those deposits, they bid up other financial assets. So I think we're just finding out that quantitative easing is very, very powerful in pushing around bond yields and bond prices.
We toss around the phrase reaction function, Bill Dudley, in the media like it's a mint. There's a mathiness to it. Can we generate constructive reaction functions given the wall of liquidity? Or do we just need to become inured to the idea we will have jump conditions, we will have suddenness over the next many 2, 3, 5 years?
Well, we'll have some suddenness in the sense that the Fed at some point is going to go from maximum monetary policy stimulus to something else. And at some point, the Fed is actually going to lift off and raise short-term rates. The Fed, I think, is going to try to minimize that jump function by communicating clearly. And I think they've done a pretty good job in terms of, signaling when the taper might take place and that it's going to take place in a gradual and in an organized type of way.
Before we came on, we were alluding to Alan Greenspan and Bill Dudley and to Arthur Burns. And do you just assume, and I say this, Dr. Dudley, very carefully, that we have, as we become less accommodative, a measured Greenspanian approach? Are we going to go back to a Fed that's more ad hoc, like we saw with some of the sudden lifts and larger lifts in the Burns era?
Well, I hope we don't go back to the Burns era, because at that time, the Fed was very, very late in terms of raising interest rates and pushing down inflation. So that would be a very bad model. I think that what the Fed is doing, though, is basically saying we don't really know exactly where full employment is. And so we want the economy to run a little hot so we can find out where full employment is and make sure we employ the maximum number of people we can without having a long-term inflation problem.
Bill, always good to get your views, especially 24 hours after the Fed has met. Bill Dudley there, Bloomberg opinion columnist and former Federal Reserve Bank of New York president. And Tom, just to weigh in on the question you asked, is something that I am calling the Dudley argument, which is the longer they wait, if they're going to be patient when they start, the argument that Bill has made repeatedly over the last couple of months is that when they start, they might have to move more quickly than people anticipate. Just the idea here that it'll be a slow start, but maybe the path from there won't be as shallow as some people expect.
With this release of this essay today for Bloomberg Opinion, John, I know we're biased. Bill writes for Bloomberg Opinion, and we're thrilled that he does that. But I'm going to make clear he is the singular former public official driving the debate.
And we'll hear from Matt Lazzetti, Deutsche Bank chief U.S. economist, on this very topic in about 5 minutes' time. Let's get to the price action of the morning, this Thursday morning. Good morning to you all. We're shaping up as follows on the S&P 500, advancing 8 or 9 points on the S&P, up 0.2% into the bond market. Yields higher by 2 or 3 basis points, Tom, to 125.76. Euro dollar 118.74. Stronger euro dollar positive 0.25%. WTI 72.62. And after Amazon, do you think we can sit here and say earnings season wraps up?
No,
TK?
no,
you don't want to go there.
I don't agree.
It doesn't
with
end
that
with
at
Amazon.
All. No, you sound
You're
like
not
a
satisfied.
Median. No,
no.
That's it. No.
What do
Dave
I sound
Wilson,
like?
Dave
What?
Wilson keeps going.
Dave Wilson keeps going.
Yep.
How long for?
It's like 3 weeks at least.
Yeah, it's
but
pretty
it
much
tapers
over.
off. It tapers
Do you think it's
off.
over, Lisa?
Yeah, pretty much. I
Thank
think it's
you.
going to trickle out.
Wilson
Good to
has
have
a
you in my
taper
corner,
tantrum.
Lisa. I appreciate it.
Sometimes.
Sometimes. 90% of the time.
Yeah.
I'll take that. Heard on radio, seen on TV. This is Bloomberg.
is entirely online, ostensibly because of the pandemic, but in large part, we're seeing a massive pivot to mostly live streams for video game coverage. We're going to be all online instead of in the convention center for the first time this year, and that promises to be a really different experience.
Industry has really been interesting during the pandemic. It has actually grown substantially since everyone was stuck inside. And of course, this makes sense, right? We're all looking for some amount of entertainment, and stuff like Fortnite in particular offer also a social component, right? People can join up and kind of meet up online and spend time with their friends. So in a lot of ways, this all makes sense.
Bloomberg surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
I think what we've seen during this period of time is that communicating via video is not a fad. We are using it in all aspects of our lives, for work, for learning, for communicating, for staying in touch.
From New York City for our audience worldwide on TV and radio. This is Bloomberg Surveillance. Good morning to you all. Alongside Tom Keene and Lisa Abramowitz, I'm Jonathan Ferro. Waiting for some economic data in America as that drops. Equity futures up 8, advancing 0.2% on the S&P 500. Yields are higher by 3 basis points on 10s. And there's the number. Again, it's the wrong kind of upside surprise on jobless claims. They come in at 400K. The median estimate 385. The previous read 419. Waiting to see if we get a revision there, Tom. But it's the wrong kind of upside surprise on jobless claims. In at 400K, the median estimate 385, and GDP second quarter annualized quarter on quarter, Tom, 6.5%. Downside surprise there too. 8.4%, the median estimate. So the wrong kind of surprises, Tom.
Right, we'll have to watch the market reaction. 2 important data points here, and let's make clear it's 2 weeks in a row of a challenge claims on the technical. You've heard me say the chart is elegant. Well, it's not elegant anymore. And again, as John says, the revision off of 419,000 last week is important. Good morning, David Rosenberg and others cautioning about the enthusiasm over present GDP. And John, that Q2, 8.4 into 6.5 is a wow first look statistic.
Not what we were looking for. 400K is the number on claims as well. That's the wrong kind of upside surprise. 385 was the median estimate, and here's the price action. Equity futures right now still elevated, basically unchanged off the back of this, up 6 on the S&P 500, advancing a little more than 0.1%. Into the bond market we go, Tom, just to have a look at the 10-year. Yields were higher by a couple of basis points, now higher by just 1. Give it time. It's early days with 90 seconds post the data. 124.42 on a 10-year Treasury yield right now, TK.
Chairman Powell looks brilliant off of this. And I'll tell you, John, we just got the revision in. It's a little bit above where it was last week. This is weekly data, high-frequency data. And, John, it's 2 weeks in a row. Not that it's a big deal, but you know what? It's not moving in that bull market direction. I don't mean the equity market. I mean the thinking about a constructive American economy.
And this is just the start. We've got payrolls next Friday, more data points still to come. And this is the language of the Federal Reserve in their statement yesterday. The economy has made progress towards these goals, and the committee will continue to assess progress in the coming meetings. Meetings, Lisa, plural.
Yeah.
We've got some time to work through this data, at least as far as the Federal Reserve is concerned.
Yeah, a lot of analysts on Wall Street saying that probably December is the most likely time when they'll begin their tapering. I will note that the 2-year yield is where we're seeing probably the biggest reaction. And I would argue that actually more than GDP, it's jobless claims, John, that get people's attention because this is where the Fed's focus is. They want to see progress in the labor market.
Slight upward revision to the previous month, 424 from 419. We were looking for a much bigger decline, though, from the previous read on claims. I said the previous month, excuse me. The previous read, 419 to 424, down to 400K, just not down to the 385 we were looking for, Tom. And as you point out, Tom, that GDP read, 6.5%. We were looking for 8.4.
We're getting to Chris Yancey starting to tear it apart for our Top Live team. And Johnny makes very clear consumptions there. We're going to get a breakout on that data as it comes along. But again, that goes to where David Rosenberg is, which is not the numbers we're looking at right now, which is the last 3 months. But where are we right now? And John, that is a raging debate. Let's go right to this right now with Matthew Lazzetti. Thrilled he's with us with a more optimistic Deutsche Bank right now. Matthew, this data, totally unfair question, but it's Unfair Thursday. Does this data allow Deutsche Bank to adjust to a more cautious economic growth?
Sure. Thanks so much for having me. I don't think it in and of itself really changes too much. We'll have to see the details there. It looks like consumer spending was actually a good amount stronger than expected in Q2. I think the key question for the growth trajectory over these quarters is actually a lot about inventory. So inventories was expected to be a big drag in Q2. We expect to get a big boost in Q3. But I think you're absolutely right. This data is backward looking. It is Q2. I think what is most important for markets and the Fed right now is the labor market data. And the stalling out of jobless claims that we've seen is an important development. Jobless claims have not been as reliable as they were pre-COVID, but it is evidence of some stalling out or some softening in the improvement that we've seen there. If that continues, it's certainly an important development from the Fed's perspective because Powell noted yesterday, certainly that is the key consideration for when they are going to taper.
Matt, for many people, September and Q4 is just huge. It's going to be massive to shape some of these debates. Goldman out earlier this week suggesting that full service sector recovery is going to take a little bit more time. They downgraded their estimates. Where are you and the team at Deutsche Bank on that argument right now, Matt?
Sure. I think there's, this is the area of debate. We have expecting goods spending to be coming off, durable goods spending, housing to be coming off. And we were anticipating that services would help lift the economy to a stronger growth profile in the second half of the year. Obviously, the return of COVID and the Delta variant is a downside risk to that. But I view it as a downside risk, not something that impacts our baseline outlook significantly at this point. I think Chair Powell made a good point yesterday. If we look back at these past waves, they were not as impactful as we were anticipating. I anticipate that will probably be the case again. And when we look at those states that are probably most susceptible that have lower vaccination rates, I think they're also less likely to bring back restrictions. You're also less likely to see those people pull back from economic activity. So it is no doubt a downside risk to growth over these coming quarters, but that's how we're viewing it, not impacting our baseline outlook at this point.
Matt, when you dig under the headline of the GDP number, are we getting whiffs of stagflation? And I know that this is the pendulum of doom. However, residential investment spending fell about a 10% annualized pace. This has to do with supply chain issues, a lack of lumber, and of course the high prices. Are the high prices a headwind to growth at this point?
I think in certain areas they certainly are. Housing is one, and yes, there are supply chain issues, but we're seeing demand come off. Mortgage purchase applications have weakened. Prospective buyer traffic has softened, so demand is being impacted. But I don't want to just focus on the prices either. We've seen, durable goods spending was 16% above where it was pre-COVID trend. Housing jumped above the pre-COVID trend. So this is a very unusual recovery. It was a very unusual recession. And we've been anticipating that these cyclical sectors will come off, even if you didn't get these price pressures. So that does make the services sector really critical to the trajectory of the economy from here on out. And we do think that it will help to carry stronger growth over the second half of the year.
Do you think that this is indicative, the weakness, or at least the disappointments that we're seeing in economic data points? I don't want to call a 6.5% growth weakness, but we have gotten disappointment after disappointment. Does that indicate a trend that will carry into the end of the year, or could things change in September when kids supposedly go back to school?
Yeah, from a labor market perspective, I think we are all anticipating, and Chair Powell and the Fed is certainly anticipating that will help to open up labor supply. We have focused on COVID as being a big driver of the constraints on labor supply, not necessarily the unemployment insurance benefits. And so whether or not schools are able to reopen significantly in September, fully in person, I think is a critical question for the labor market outlook. At this point, we just don't know. We'll have to see how the variant evolves over the next couple of months, how policy evolves over the next couple of months.
Yeah.
But that will be a really important consideration for getting back to maximum employment or these types of labor market numbers that the Fed wants to see.
There's a lot we don't know. There's a couple of things we can take a good guess on. One of them is inventories, and you mentioned that earlier on, Matt. This is what Luke Cower had to say of UBS. The 1.1 percentage point drag from inventories in Q2 is just not sustainable in the slightest. Yesterday's drawdowns equal tomorrow's demand. Matt, would you go with that as well? That seems to be what has led us towards this downside surprise this morning.
Absolutely. So we were below consensus on this GDP print. The key driver of that being a big drag from inventories. We know we have in the retail and especially in the auto sector, very low inventories, which we expect to begin to build in the second half of the year. And so I think what you tend to see in these numbers, if private final demand is actually pretty strong, which it looks like it might be given strong consumer spending, you should get a reversal of inventories, and that should help to lift your Q3 growth number versus Q2.
Matt Lazzetti, I'm going to use a word for Jean-Claude Trichet that he loves to use, and he says it with a French accent, which has got a lot more panache than you and I are going to do, and that is diffusion. There's a belief here and a mystery about the diffusion from a goods-centric consumer over to a service sector consumer. Do we see that in this data, or does that wait for another quarter's report?
We have been seeing it in the monthly data, no doubt. We've seen good spending, retail sales in nominal terms has flatlined out over the past couple of months. And adjusting for prices, given how strong price gains have been, we've seen weakness in real spending on goods. I want to emphasize that was to be anticipated. We were well above trend on goods spending, and price pressures are obviously having an impact. So we expect this handoff to the services sector to continue over the next couple of months, next couple of quarters. We're still below where we anticipated we would be in leisure and hospitality and all these other service items. So I think that should continue to be the key driver for growth going forward.
Matt Lazzetti of Deutsche Bank, you're not alone, sir. It's good to catch up. Thank you very much. This from Neil Dutter of Renmac. Inventories cut GDP by 1.1 percentage point. This was a significant part of the miss. Eventually, inventories will need to be brought into line with final demand. When that happens, top-line GDP growth will surge. This is good news for future factory production. Just some of the takes from Wall Street this morning, Tom, off the back of this miss. Looking forward, the look forward, still, the consensus view is, as this year grows older, Tom, the supply side of this economy will heal in a more profound way, and maybe we can solve some of these issues.
I would say the partition between the optimists and those more cautious is when does service sector growth really click in? We don't see that here, but maybe we'll see indications rapidly towards where we are in Q3.
And on that point, Tom, Lisa, just a final word on this. To what degree, to what extent has that been delayed, given what we've seen over the last couple of weeks?
And especially because we're not seeing the frictions in the labor market really resolved. And I want to just emphasize that, yes, there are there's a forward look in the GDP figures that's more positive. The jobless figures, stubbornly high initial jobless claims, and you just wonder why.
We're going to have that conversation in about 15 minutes' time on The Open with Sibaja Rajappa, Societe Generale's head of U.S. rate strategy. David Kelly of J.P. Morgan joining us as well to work through some of the issues. Your equity market, not doing much today, up 7 points on the S&P 500, advancing a little more than 1/10%. The dollar breaks down a little bit, negative 0.4%, a weaker dollar. The dollar index breaks back down through a 92, 91, 95. From New York City on radio, on TV.
Didi, $10.44.
Thank you, TK. I knew it was coming. I'll leave the space for you. Just left it there. Anything else?
Didi.
You good? Didi. Okay, Didi. You enjoy your time off. I'll see you Monday. This is Bloomberg.
With the First Word News, I'm Leanne Gerrans. That $550 billion infrastructure passage has cleared its first barrier on Capitol Hill. The Senate voted to begin consideration of the bill. 17 Republicans joined all Senate Democrats and 2 independents in voting for the measure. Lawmakers expect the final passage to last into the weekend and possibly even next week. Now, the new chair of the Federal Trade Commission is vowing to return the agency's trust-busting roots. Lena Khan told reporters she intends to use the FTC's full arsenal to take on companies that prevent competition. Khan also signaled she's not afraid to take on risky cases that officials have really shied away from in the past. China may be preparing for a period of prolonged tension with Washington. Beijing's new ambassador to the U.S. is a veteran diplomat known for pushing back against Western criticism. Chen Gang most recently served as vice foreign minister. He told reporters he would work to put U.S.-China relations back on track. It was one of the most anticipated listings this year. Robinhood raised $2.1 billion at an IPO priced at the lower end of the market range. That gives the trading app company a market value of just under $32 billion. Robinhood shares do begin trading today. Comcast beat estimates for second quarter sales and profit. The company signed up a record number of new internet customers. Meanwhile, there was a surge of advertising revenue at its NBC Universal division. Comcast continues to lose cable customers as more people turn to streaming. Still, 399,000 video customers who dropped the service were actually fewer than were expected. Global news 24 hours a day on air and on Bloomberg Quick Take, powered by more than 2,700 journalists and analysts in more than 120.
Market that over the past few weeks has made it clear it wants to go higher. It got a little spooked by the idea that geopolitical tensions are rising.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Some of the best deals in history have been passed on by a very large number of people. The money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
markets never sleep, so stay connected with Francine Lacqua in London, Matt Miller in Berlin, and Kaylee Lyons in New York. Perspective on the day ahead. Bloomberg Surveillance, early edition. Weekday mornings on Bloomberg Television.
Straightforward solution. Support and grow more American-based companies. I can sum it up in 2 words. Buy American.
President of the United States talking of Buy America, and we'll talk about that in a moment here, and of course how it wraps into legislation as well. It is an electric car company, and it has been statements made from the gentleman from Utah who basically came out of school as a sales and marketing executive and now is a bit challenged. He is Trevor Milton of Nikola, and it's real simple. The U.S. attorney in New York unseals an indictment against Trevor Milton. We'll have much more on this, and I believe there is scheduled a press conference by U.S. attorneys at 11 a.m. Bloomberg will be following this on the island of Manhattan this morning as well. Right now, and this is really, really important for your infrastructure, we go to the gentleman America, different from maybe inside the Beltway in Washington, and we're honored that he could join us from inside the Beltway in Washington this morning. Dan, you and your family and your constituents have lived the worst water crisis in America. You know better than anybody about lead pipes, about water structure. Is this bill good for Flint, Michigan?
Well, it's hard to say. It's a step in the right direction. The question is whether or not there's enough of an emphasis on water infrastructure to prevent the next Flint, Michigan from happening. In some ways, you know, and ironically, Flint has some advantage in the fact that the failure of Flint's infrastructure occurred in public view. I was able to get help for Flint, even when I was in the minority, to replace the lead pipes there. But the real question is, will the warning that Flint provided the rest of the country be heeded? Will we have enough money in this legislation to replace every lead pipe in America? And I'm not sure yet we do, but maybe it's a step in the right direction.
In the third world crisis of Flint, Michigan and water, there was no discussion of pay-fors. It was like, let's go, let's fix it. How do you respond to this juvenile debate over how we're going to pay for this versus let's go?
Well, the way I respond, it's a really good question, is to point out that when it comes to water infrastructure or other infrastructure failures, we're all going to pay for it. The question is, you can pay now or you can pay later. Flint's a good example. If Flint, say 7 years ago, had $30 or $40 million of...
Traders, I'm going to place an order to buy euro. Oh, it's too late. It's probably too late. Right now, it moved already high. I was looking to buy euro at 118.75. But as you can see, it moved straight away up. It just jumped straight away up. So in the meantime, false alarm. Okay, guys, I'll speak to you later.
Year is not that big, especially when spent over 8 years. How much in the conversations that you have in the negotiations that burn the midnight oil as you eat tacos and chicken parm each night as you try to hash out the details here, how much of the debate is connected to the $3.5 trillion plan that Senator Sanders is working on right now?
It is connected because if, in fact, we have a bipartisan deal, and the president, many of us have been very committed to do as much as we can in a bipartisan fashion. That doesn't mean our work's done, but it pushes more of what we may need to do into a reconciliation package. And the concern that I have is that some of our senators who seem willing to work together on the bipartisan piece get a little cold feet when we think about what we want to put into the reconciliation package. And I'm talking about Democratic senators in this case. We've got a lot of business ahead of us. If we don't fix this stuff, it doesn't mean it goes away. It doesn't mean that China is not spending 10 times what we are as a percentage of their GDP on infrastructure. what I'm trying to convey to my colleagues is we really don't have a choice. We have to do this. We can't have an infrastructure bill that says 1 out of 4 Americans get to have 21st century infrastructure. The rest of us have to compete with 19th and 20th century infrastructure. Sooner or later, we got to fix it. And so more of it may have to be pushed into that reconciliation bill if we don't get enough in the infrastructure package itself.
Which raises a question, Congressman, about unity among Democrats. There's been a lot talked about the splintering of the party, the whole progressive versus the more moderate wing. Given the conversations that you're having, how difficult is it going to be? Can you characterize whether people are coming together and coming to a more unified vision here?
It's hard. I mean, one of the things about having a party with a lot of diversity of thought is that we have a lot of diversity of thought, and it's often hard to land on the same spot. The tough thing is, if we're all being asked to compromise, we all have to compromise. We can't have a situation where somebody on the left says the right has to compromise or the middle has to compromise. If we're going to come together, that means everybody's got to acknowledge that the final product is something that if they were doing it by themselves, they wouldn't do it. And right now, I'm not sure we've completely landed that message. I think too many folks are taking an absolutist approach that without my specific priority, I'm not going to help. And that is not the way this place is designed to work. And the American people don't care what the excuses are. They just want us to get this work done. They want us to get the work done that affects their lives. You know, the Beltway arguments are of no interest to the people I represent.
Dan, I got like 14 more questions, but we don't have enough time. Dan Kildee of Flint, Michigan, thank you so much for joining us today. The congressman from the 5th District in Michigan. Lisa, what's so interesting about that conversation is this is a guy with a whole family heritage of the district, and he's part of what's called the Free Thought Caucus in Washington. I think there's like 12 members. That's all they could get, looking for reason and science within the debate of public policy.
Free thought and Reed centrist. And frankly, they are leading the whole ball here when it comes to driving some sort of bipartisan agreement. So interesting to see how they're going to wrangle all sides, both for this and for the $3.5 trillion spending plan. Can I just say something, Tom?
Oh, please.
As we were talking, MasterCard released earnings. And I think that this is actually quite interesting because it goes to card spending. Card use in the U.S. soared 36%, just to give you a sense of how big this was. And purchase volume climbed to $1.47 trillion. This is way ahead of estimates. Yeah. The whole idea of the consumer is strong. We saw that in the GDP spending, and that really it's more supply chain constraints and getting inventories that's holding up some of the growth. But to me, as far as the consumer goes, they've got a lot of money. And they're spending it.
And there'll be a second look. Let's remember, there's first look, second look, third look to any GDP, and even after that, years is revision. But I agree with a lot of the people, John Farrell mentioning Neil Dutta earlier, that let's focus on where we are right now. And dare I say, Lisa, there's a huge mystery right now to Q4. I mean, nobody has a clue.
And a lot of this has to do with how quickly some of these frictions get evened out. And that's the flip side of this. Corporations saying it could be a pretty long runway. So these are sort of, the push-pull effects.
Stay with us. Also, the news through the day on the pandemic and on masks in the CDC. Part of the conversation, balance of power, 12 noon today with a senator from Florida, Rick Stock. Please stay with us. This is Bloomberg. Good morning. up to Maine and had a lobster. And it's not as romantic as Lisa going to Greece.
Tom Keene says what?
You mentioned Maine and the lobsters up in Maine. Well, they can't compare to what you can see in Greece. Even better, I can't pronounce it. Astacoma carinata.
I nailed it.
It's not thera, whatever. Astacoma.
You're nailing it.
Carinata.
You're nailing it.
We're figuring out the hard stuff for you on Bloomberg Surveillance. Mornings on Bloomberg Television and Radio.
Valuations, particularly, sort of the technology landscape, have gotten to some pretty extraordinary levels. So I think it's not a surprise. I don't think it's any indication of the beginning of the end, but I do think markets don't like uncertainty.
Trading revenues coming in better than expected. Everything. Cash, $1.4 trillion of cash. One of the most notable aspects of this report that was stellar.
Live from New York City for our audience worldwide. Good morning, good morning. The wrong kind of surprises on the economic data in America. With 30 minutes until the opening bell, the countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Ferro.
From New York, we begin with the big issue, talking about tapering.
The primary objective was signaling in terms of tapering.
Take some steps, get them out of the way.
Talking about tapering.
And therefore prepare the ground for tapering.
The Fed was reasonably clear.
They gave us some clarity.
His comments were pretty clear.
The markets are fairly stable, so I don't think you'd be too upset with that, really.
I did not hear any encouragement to the view of an early tapering decision.
They're not going to be doing any tapering. They're going to keep with the mortgage-backed security purchases, keep putting the liquidity into the market, and keep interest rates where they are at the moment.
He's given himself a lot of latitude, either to signal or not to signal anything more come Jackson Hole.
I don't think any of us has a playbook on this, and I think the Fed knows it.
The Fed knows it. Joining us now is SocGen's Savannah Rajappa, JP Morgan's David Kelly, and Citigroup's Sean Snyder. Savannah, I want to begin with you. Fold in the non-decision from yesterday into the economic data from 30 minutes ago. What's your thought?
So this is exactly what we're concerned about, right? You get a much lower GDP than people had anticipated. The claims number is a lot higher than we had anticipated. So this is really goes to the core of the concern, and that's why the Fed has given themselves a lot of flexibility on when they can taper asset purchases. Yes, they took a very important first step, but really from this point on, it's a waiting game on data. We need to see strong data trajectory towards steady improvement in both employment as well as growth for the Fed to be able to be comfortable about tapering asset purchases or announcing tapering asset purchases later on this year.
David Kelly, your takeaway.
The GDP number is a lot stronger than it looks at the surface. Yes, 6.5% growth was weaker than people thought, but that was because of a $166 billion annualized decline in inventories. Final sales, what people are actually buying, rose by over 14% in real terms. So there isn't a slowdown here. What there is a huge drawdown in inventories. And what we know about inventories is they swing. And we're going to have to rebuild them in the second half of the year and into next year. So yes, we've got weaker growth in the second quarter, but it is all just adding on to growth in the second half of the year and early next year. So I think the Fed is, they did lay out a sort of timetable for talking about tapering. I think they should stick to that timetable. Frankly, I think they should accelerate it. Because I think the economy is recovering on track here despite this morning's GDP number.
Well, David, we can get to that point in just a moment. Sean Snyder, I'd like your thoughts as well. My former colleague, UBS strategist Luke Cower, saying yesterday's drawdowns equal tomorrow's demand. Hard to disagree with that, Sean.
Yeah, so when I think of the GDP data today, I'm actually, I have to say the Atlanta Fed GDP Now tracker got it almost exactly spot on. They came in at 6.4%. We got 6.5%. But I absolutely agree with David. If you look underneath the hood, you have 11.8% rise annualized in personal consumption, and that's really the driver of the economy. It's how much the consumer is spending. So I think that was positive, and I agree. The inventories are always hard to forecast. It is the most difficult section to forecast, and it swings wildly. So I still think this is a pretty good report. When it comes to the Fed, I think they're taking baby steps towards tapering. I think Delta gives them some reason to be a little bit more delayed or cautious, and maybe this growth number does. But I think on average, we're going to have pretty strong employment prints, and I think the consumer remains in really pretty good shape. So I think we are making progress towards their goals.
Let's talk about that progress towards their goals. On the labour market, on the Fed, this was Chairman Powell.
We have not reached substantial further progress yet, so we're not there, and we see ourselves as having some ground to cover to get there. I would want to see some strong job numbers.
Let's bring in Carl Riccadonna, Bloomberg Intelligence Chief Industry Economist. Carl, as Bank of America said, we've made some progress on progress. Do you agree?
We've made progress on progress. I think we can say we've made substantial progress on inflation. I think we can say we made substantial progress on economic growth, because as we see in today's GDP data, we're now back above the peak before the coronavirus crisis began. And while Jay Powell in his press conference said we're looking at an array of economic indicators, he always zeroes in back on that jobs deficit. So that is clearly front and center on his dashboard. Absolutely, he's looking at a panoply of labor data, but he is very focused on that job shortage. And so we can, if we look at progress versus substantial further progress, when that substantial further progress language was introduced at the December FOMC meeting, we had a jobs deficit of about 10 million workers relative to pre-coronavirus. That now is about 7 million. So we've made progress, but that gap is still a very large gap. And you can make the case that there are some workers who retired or have left the workforce for good. However, there are a lot of new entrants to the labor market who graduated from college or high school during the course of the crisis. So that gap is very large, and it points to substantial slack in the labor market. I don't think today's data changes anything with respect to the timeline. I think still a taper in the first part of next year makes sense. However, Jay Powell is making clear, and the data make clear, that we are nowhere near the point where we should be thinking about liftoff on interest rates, and I still think that timeline could actually slip further out.
Carl Riccadonna, thank you, sir. Let's build on that with the guest, the panel. David Kelly, to you first, sir. How much daylight is there between what you would like the Fed to do and what you expect the Fed to do?
There's quite a lot, because the economy is clearly recovering. Obviously, the Delta variant is something that we have to think about. But the problem is, inflation has moved up, but more than inflation, asset prices. I mean, every month that the Federal Reserve leaves interest rates at anomalously low levels, at levels that don't make economic sense, you foment bubbles you've got bubbles in housing, you've got bubbles in some areas of tech stocks, in other areas, and you want to move away from that, because most recessions in recent history have been caused by bubbles. I think the Fed is creating them. So I think the Fed should take a breath but normalize. And at this stage, people expect them to be dovish, so they're going to have to take it easy. But I hope that they at least stick to this timeline and begin to taper in December and announce something at Jackson Hole or in September.
The economy has made progress towards these goals, and the committee will continue to assess progress in the coming meetings. Subhadra, meetings plural. To David Kelly's point, this feels like a December moment more than a September one.
Well, it could be an announcement in November, or earliest in November, because by November they'll get 3 employment reports. So they should have a pretty good read by then on where the employment picture is and whether they're comfortable calling for substantial further progress on employment. But I'm very much in agreement with David. I think that they should definitely be normalizing. They should be thinking about tapering asset purchases. They're clearly teeing up that exact scenario in the statement. All they have to do in the next couple of meetings is, when the time is right, insert the word substantial, and then they can start announcing, an exact schedule of tapering asset purchases. And I think that is very important, because like David pointed out, I think you're seeing a decent amount of risk taking. Interest rates are extraordinarily low, and we need to see a normalization of interest rates, broadly speaking.
Sean Snyder, it's easy to get emotional about the Fed. A lot of people in this market do. We become consumed by what we think they should do. and we lose sight of what they probably will do? What do you expect them to do?
Well, I expect them to taper eventually, whether it's late this year or early next year. I think they absolutely want to do that, just because there is some time frame in between where they need the the tapering to run off before they can really consider hiking rates, I think. So I expect them to kind of announce tapering. When it comes to what they're going to do with interest rates, I actually think an interesting story that no one's talking about is, we could actually be looking at decelerating inflation next year in mid-2022, and maybe that changes the story from what we have now. I know right now we seem to have peak anxiety about inflation, but we talk about this normalization of the economy. Peak growth doesn't necessarily mean weak growth, but I do think it will moderate as we normalize and move into a more mid-cycle economic expansion, and I think inflation is going to do the same.
Well, let's pick out that
word.
word.
This time next year, the story is going to be very different from what we're talking about today.
That N word, Sean, normalization. Let's build on that a little bit more. Normalization, the full service sector recovery. This week started with Goldman. The team, Jan Hatzius leading them over there, the team of economists talking about the extent to which that recovery would be delayed, which led them to downgrade their forecasts. And through the week, what have we seen? Company after company delay the return to the office, talk about mask mandates, vaccine requirements. Building on that, let's bring in Bloomberg's Kelly Lyons. Hey, Kaylee.
Hey, John. Well, coronavirus cases are surging here in the U.S. due to the Delta variant. We know that. And the CDC is changing its mask guidance as a result. We know that, too, telling anyone, even vaccinated people here in New York, in L.A., and in 39 states where community transmission is either high or significant, that they need to put their masks back on. That doesn't necessarily leave companies with clear direction on what to do, though. And we're seeing a number of them decide maybe now is not the best time to bring people back into the office. And it's not just about when people come back. It's also restrictions once they get there. Citi this morning reinstating its mask requirement in offices after that new guidance from the CDC. Apple going back to both workers and customers in most of its stores having to wear them. And even Disney parks. If you're planning on going on a vacation there in the next couple of weeks, guess what? Mask up. And it's not even just mask mandates anymore, John. It's vaccine mandates, too. We're seeing that with Google and their employees that are returning to the office. But that may just turn out to be another disincentive for employees who already don't want to stop working from home. Some maybe even would be willing to quit if they have to do so. A survey back in May found 45% of employees would quit their jobs if they couldn't work remotely full time. 49% would if they weren't allowed a hybrid setting, and 52% of people willing to take a pay cut in order to work remotely, John.
Kelly, thank you. Two big issues here. The economy, the recovery, to what degree that recovery has now been delayed, that normalization process that Sean talked about there. And then we need to turn to Subhadra and talk about what on earth it means for this bond market. David Kelly, I want to come first to you. The view from Goldman earlier this week. In the near term, a complete service sector recovery will likely require fully overcoming virus fears and returning to office work patterns. Both now appear likely to take longer than we anticipated. The end result, they downgrade their outlook. Have you had to do the same, David?
We are thinking about it a little bit. I mean, we think this, the Delta variant, unfortunately, if you look at what happened in Britain, who's running about a month ahead of us, it does look like, we're going to be looking at cases over 100,000 per day. And yes, some mask mandates will come, increase, and that may change some plans in the fourth quarter. But remember, throughout this pandemic, we've adapted to a pandemic economy. So it doesn't really slow down overall growth. We've figured out ways of doing stuff. So, I think the schools will all be open. I believe people may be wearing masks, but the schools will be open. I think the sporting events will all be open. So I think most of this service sector recovery is actually going to occur. And then, looking at today's data, we've just got this huge inventory bill that's necessary. So I'm not really, we're already above where we were before the pandemic in terms of GDP. And I think the second half is going to be very strong. So maybe not as strong as it would have been if we'd fully overcome the virus, but I think it's still going to be really strong.
Well, let's talk about what it means for this bond market. 2s, 10s, 30s. Your 10-year yield right now, 127.60 on 10. Subhadra, if everything plays out in the way that you, Sean, David anticipate, what does it mean for this bond market?
Well, at this point, I think I've kind of dialed back my expectations, but there should be a gradual rise in yields, right? You have to see a normalization of bond yields. 10-year yields at 125 doesn't make a whole lot of sense. But for that to happen, the Fed has to step away from asset purchases. I think what's really holding back, especially real yields are at historic lows, is the fact that the Fed has bought a lot of treasuries, and they're kind of compressing term premium as well as compressing nominal bond yields. And inflation expectations are rising because we're seeing core CPI and core PCE rise, and that's kind of pushing down real yields. So we need to see a synchronized rise in real yields. We need to see higher inflation expectations, and that should lead to higher nominal yields. And that's kind of my base case expectation.
Sean, I wonder what your base case is for the second half. Sabadra's given hers. This is what Chairman Powell said about the fall in Treasury yields. I don't think there's a real consensus on what explains the moves between the last meeting and this meeting. No consensus, Sean, on yields being down here and why they're down here, yet I hear a lot of why they need to go higher. Are you on that side?
I do think they need to go higher. I thought it was kind of interesting yesterday when Fed Chair Powell said, you know, some people attribute it to market technicals and no one really knows what that means. They just lump it into that basket. So I think there's some acknowledgement that it is a bit confounding. But, you know, I think there's really three reasons. One, the Delta variant. I do think there's some caution around that. And, you know, the bond market sort of did get it right. You know, we didn't see the 10.5% growth. We saw 6.5% growth, even though under the hood it did look better. Then you also have, you know, this element of, you know, the market technicals, right? So there was reduced supply of treasuries during the first half. You know, I think that played a factor. I don't think that's going to be as big a factor in the second half. And then, of course, just, you know, lowered inflation expectations for a little bit. But I think those are going to rise again. So I do think maybe you're looking at a 10-year of 1.5% to maybe 2% towards the back of the year.
Sean Snyder, alongside David Kelly and the brilliant Sabadra Rajappa, sticking with us. Abigail Doolittle has some of the movers at a market desk. Morning, Abby.
Good morning, John. And the U.S. futures basically flat to mixed. Under the surface, though, big movers. Let's start off with the shares of Nikola because they are plunging on the breaking news over the last hour that the founder, Trevor Milton, has been charged with misleading investors on the EV startup. You can see the stock down 7.4%. Also lower on earnings, Facebook. Now, they put up a great second quarter, beating top and bottom line estimates. However, the growth of the revenue growth up 56%, not sustainable, the company is saying, in part because of the Apple software update restricting data collections. So those shares down. You can see a bit of a mixed reaction for some of the other social media companies, but mainly it's hitting Facebook, that news. And then we have bonds off. That means yields higher. That's helping out the big banks. So reflation is back in vogue today. Pretty nice gains for all of the big banks, John.
Abby, thank you. Bank of America up 1 full percentage point. Coming up on the program, President Biden's economic agenda taking shape. The Senate voting to begin work on a bipartisan infrastructure bill. That conversation is next. From New York, this is Bloomberg.
Happening in the business world right now is how to get workers back to work and what benefits to give your employees. Microsoft is asking employees to be back in the office 51% of the time, but you're flexible about the rest of the time. Is that a permanent policy? And for those companies that are saying you have to be back in the office 100% of the time, are they on the wrong side of history?
I think we at Microsoft, we want to be much more data-driven. I also think that in time, if a year from now, we will have more sense of what the real structural change and needs and the expectations of both our employees and our customers are. And we'll really think about long-term policies based on, quite frankly, having all of that data behind us, because otherwise I think we are trying to come up and being too overly dogmatic when I think we need to be more experimental in our approach to return to work, because I do fundamentally believe the world's changed.
It's really a reminder, isn't it, just how sensitive the markets are to any commentary about trade. We did see some pressure on the yuan, we did see some pressure on the futures. That is now being reversed.
like we reached a bipartisan agreement on infrastructure. And I'm working with Democrats and Republicans to get this done because while there's a lot we don't agree on, I believe that we should be able to work together on the few things we do agree on. I think it's important.
Lawmakers voting to move forward on a bipartisan infrastructure package. GOP leader Mitch McConnell giving the deal a bit of confidence. He tweeted the following, quote, "I will vote to proceed to the bipartisan infrastructure bill." Short, simple, sweet. Down in Washington, D.C., our Washington correspondent Anne-Marie Hordern joins us from Capitol Hill. Anne-Marie, walk me through the process now, through the next week or so.
Good morning, Jonathan. Well, that tweet from Mitch McConnell, and he did vote yes, along with 16 other Republicans. We should note, though, that is just procedural to get the legislation on the floor. Doesn't mean he's giving a yes for the actual bipartisan infrastructure agreement, but it is a positive movement, at least for this bipartisan group that came together on this. Jonathan, we should just also note how much money we're talking. This is billions of dollars that's going to Amtrak, electrical grid, chargers, things like roads, bridges, all the classic hard infrastructure. One thing to also note is that we don't even have the actual text legislation. We know this through memos from the Republicans and also the White House. So first we want to see the actual text legislation. A few other Republicans were complaining about that. They want to see the actual bill before they vote on it. And then it's just going to be a lot of negotiation.
Traders, it's time to place an order to buy British pound. And I'm looking to buy at 139.588. It almost touched, but we didn't fill yet the order. So it's just right here. So if you still have time to place order. So if you want to trade British pound, here is your chance. Place an order, it will get filled. Stay with me and we'll go through. Hopefully we will get this order filled, even if it moved away from our order, but hopefully we will get filled, okay? I'll speak to you later, guys.
Quite meaningful on the debt and deficit side of the equation. For now, the expectation is that the Treasury will reduce its coupon supply at the November refunding meeting, but broadly speaking, I think the higher debt and deficits are going to be here for the foreseeable future. Really, the impact is on the infrastructure deal is going to be a lot more drawn out from a growth perspective than what we saw from the CARES Act or the relief programs that we got this year. So the impact on growth is going to be a lot more modest. So that's what we're really focused on. There's not going to be any near-term impact on the bond market based on the infrastructure deal.
David Kelly, your view.
Yeah, I agree with that. I think there are two things. First of all, I agree with Subhadra that the most important part of this is the reconciliation bill, the omnibus reconciliation bill, which I think this unlocks. Because what's going to happen is that over the next month or two, we're going to have to get this reconciliation bill through. First of all, we've got to raise the debt ceiling, which expires at the end of July. And, you know, we can go a month or two, but not much longer than that without raising it. And the child tax credit is going to be very popular, and that's going to have to be put into that reconciliation bill. So there's going to be tremendous pressure on Democratic moderates to pass that reconciliation bill to A, prevent a default, and B, to sustain some of those tax credits. So I think that's going to happen. And the thing about any legislation is, you know, they may say it's paid for over 10 years, but you know how that works. Yeah, we're going to spend the money now, and we'll maybe pay for it later. And so later down the road, so it does amount to a significant fiscal stimulus. And, you know, you can add that to, you've got reopening, you've got inventory rebuild, and I think you've got a lot of fiscal stimulus funneling into 2022 to add to the overall growth picture.
David Kelly, bullish on the outlook. Sean Snyder, your take.
Well, listen, I think anytime you get a bipartisan bill, I think it's a positive. Does it move the needle for the markets right now? You know, maybe not. But I do think that's a positive. And as everyone has already mentioned, it's really about what happens this fall when we see the larger infrastructure bill, the so-called, you know, social spending agenda, and whether or not that goes through on a party line.
Position open on British pound at 139.588. Okay? Well done, guys. If you decided to follow my trade and if you decided to trade British pound right now, well done. It moved up right now. As soon as it will move to the right level, we will place stop. So we will not lose any money. And then we will move our stop higher and higher. So this way we will control will be in control what's going to be with British pound. Okay, guys, stay safe.
This is Bloomberg.
Mercedes-Benz is on a path towards CO2 neutral mobility. So we have flicked the switch there, and really we're going to step by step electrify everything. And what does that mean? Combustion engines get electrified.
Minutes away from the opening bound this Thursday morning. Good morning. Here's the state of play. The price action. Equity futures up 0.2% on the S&P. Clear outperformance on a small caps, positive 0.75%. Bit of underperformance on the Nasdaq 100. Big cap tech down by a little more than 0.1%. That's the price action. Let's get you some morning calls and begin with the team over at Guggenheim. Upgrading Spotify to a buy. 265 price target. The analyst saying it's established a sustainable position as the global audio leader. Next up, KeyBank upgrading Zoom Video to overweight, 428 price target. The analyst seeing a future of hybrid working, making video and cloud communications a long-term priority. That stock is up by almost 2%. And finally, Argus upgrading Raytheon to a buy, $100 price target. The analyst highlighting a favorable business mix and attractive valuation. That stock at 88.35, advancing by 1.32%. Coming up, the clampdown in China sparking confusion over Didi. And later, Jefferies analyst Brent Thill joining us to break down Facebook's quarterly results. Still to come from New York, this is Bloomberg.
Okay, guys, let's place stop on profit for British pound. I'm going to place stop on profit at 160.8. Just right here. It will give us 2 pips in profit, and we will get, if it will change direction, we'll get £200 in profit. So stay with me, place stop on profit. We didn't close yet this position, so it might move higher, so we will increase our stop. Okay? Stay safe, guys.
Time here. Have you got
Commodities are up.
Keep going.
To the moon.
Beautiful.
Bloomberg Surveillance, weekday mornings on Bloomberg Television and Radio.
Every Friday with 30 minutes dedicated to fixed income, I'm Jonathan Ferro. This is Bloomberg Real Yield. 23 seconds away from the opening bell this Thursday morning. Good morning to you all. Let's work through some price action together. Your equity market looks like this on the S&P 500. Up 10, advancing 0.2%. Clear outperformance for the small caps. The Russell 2000 up by 0.8% this morning. The Nasdaq just with a touch of underperformance on the Nasdaq right now. Negative 27 and down 0.2%. That's the opening bell. Switch on the board and get to the bond market. Yields look a little something like this on 10s. 127.26. Yields are higher by 3 or 4 basis points. On the surface of things, that GDP report disappointed. Beneath the surface, it's an inventory story, and we should get some positive payback in the coming quarters. Look out for that conversation through the market day. In the FX market, euro stronger, approaching 119 again, 118.79, up by 1/3%, and crude 72.88, up by 0.7%. From New York, that's the cross-asset price action. At the market desk with your movers, here's Abby.
John, beneath that relatively benign surface for U.S. stocks, let's take a look at what's moving. First up, Facebook shares are down. This after the company put up a very strong second quarter. They beat both top and bottom line estimates. They also had fantastic revenue growth, up 56%, driven by pricing up 47%. However, they are warning that that growth may decelerate in the coming quarter. So you can see the stock down 2.7%, and the deceleration may have something to do with Apple's privacy policies. Taking a look where we have green for a second day, gains for the Chinese ADRs. You can see Didi in particular up 17.4% on the report that the company is considering taking itself private, going private to satisfy Beijing and also to help out investors, certainly helping out investors and that entire space that has been down. China tech down 50% recently, so 2 up days, small, but maybe a start of something. And then finally, rounding it out with the reflation trade, we have both banks and energy higher. You noted that 10-year yield up 3 basis points, the yield curve steepening, oil up. That means reflation is on, at least today, John.
Abby, thank you. About 2 minutes in, energy indeed top of the pile, advancing by 1.46%. On the S&P 500, we advance about 1/3%. Bottom of the pile, information technology, basically unchanged on the session. Communication services down by almost 0.5%. The confusion around Didi has been phenomenal. Shares surging following a Wall Street Journal report unveiling some kind of talks of going private. The company quickly denying the report and issuing a statement writing the following, quote, "The company affirms that the report is not true. The company is fully cooperating with the relevant government authorities in China in the cybersecurity review of the company." For more working through this is Bloomberg's Kaylee Lyons. Hey, Kaylee.
Hey, John, I wish I had clear answers for you, but I would just remind you that this company has only been public in the U.S. for a month now, and already there is confusion swirling about a possible privatization. Granted, since this Chinese ride-hailing company listed in the U.S. in June, it pretty much has immediately faced trouble. Beijing announcing a probe into it, removing its services from Chinese app stores, and Bloomberg reported last week that regulators were considering serious penalties for it, including forcing it to delist. That had the shares down 36% from its IPO to today. And then, of course, today's rumors lifted the stock nearly 50% in pre-market trading. It opened about 19% higher after the company's denial of that report. Of course, it's not just Didi that had been wrapped up in this Chinese crackdown, John. It has spread all over the tech complex, from food delivery to education companies. And that has really punished the Hang Seng Tech Index recently. It's down 36% from its peak in February. Even with the rebound we have seen in the last 2 sessions, that index rose actually 8% overnight. And in part, that was due to steps from China to calm the market. A report that Beijing will allow local companies to go public in the U.S. still. That gave a lift to stocks listed stateside. And Asian trading. The likes of JD.com, Baidu, Alibaba, all surging double digits in the Asian session overnight. And as Abigail mentioned before, those ADRs also in positive territory at the U.S. opening bell, John.
Kelly, thank you. It's called the Plunge Protection Team for a reason. Chinese authorities convening with investment banks in some kind of attempt to soothe markets amid Beijing's crackdown in the private education industry and beyond. We caught up with BNY Mellon's Jeff Yu on this. Take a listen.
I think China is learning as well, like any regulator. This is a new environment for China. They've realized how invested in the international community is in certain sectors, right? So again, education and being one of them. Of course, they don't want to damage sentiment either. They will learn as well from this, and as future sectors go by, maybe they'll do it differently.
Still with us for some final thoughts, I'm pleased to say. So Subhadra Rajappa, David Kelly, and Sean Snyder. And guys, don't worry. Always try and protect you. Not going to get you in any trouble talking about single names, Chinese tech firms like Didi and the rest. But David, I do want to talk about the risk of contagion here, the transmission mechanism from China and any kind of slowdown there into the US economy and beyond. How are you thinking about these issues at the moment, David?
I don't think there's that serious a threat. I mean, I think there are real questions about valuations of some mega cap growth stocks in the United States. But the China issue is really about Chinese nationalism and the control of the Chinese Communist Party over various things that go on in China, and how much they want to exert that control and what price are they willing to pay in terms of stock market performance and financial performance. And we seem to swing. They seem to be swinging towards the side of more regulation, and they're willing to take a financial hit, and then the financial hit occurs, and then they sort of swing back a bit. But I think that's really a China story. I think Chinese growth is still solid, and more than that, we've got Chinese vaccinations rising very rapidly. Vaccinations are rising rapidly around the world. So I don't think it changes the global growth trajectory, and therefore I don't think it really has a big effect on U.S. economic growth or our domestic story.
Subhadra, how would you frame things?
Yeah, so what I'm looking at is the RRR cut that came in the last month, which I think caught most market participants by surprise. Credit conditions are starting to tighten, and you're seeing some easing of monetary policy to accommodate for those tightening credit conditions. I don't think it's worrisome, but typically when you start to see credit conditions in China tighten, you tend to see that the world follows with a one-year lag. So that's what I'm looking at. I think it's still too early to draw any conclusions. The fact that they're proactively easing policy is a positive, and that should, help the global growth outlook.
What about you, Sean? A couple of ways to think about this. Some people are exposed to these stories via a basket of stocks and index, can think about how it bleeds through Asian credit and back out to broader markets too. How would you frame things, Sean?
So listen, I think what happens in China does matter to the world, but I do think the global economy is going to continue to recover. When I think of China, there's so many different nuances going on right now. So to me, rather than walking through all the details, I actually think it argues for active management versus kind of passive here, because there are so many details going on. And I will say that, if we look at past sell-offs of the Chinese market, 30% sell-offs, in the next 12 to 18 months, you tend to get double-digit returns. So, maybe it's a bit of a contrarian call, but I do think we've seen a sharp sell-off there. And I actually think it might make sense to add some exposure there. But again, maybe through active management.
Well, let's get to another contrarian call. David Kelly, your call. Stocks over bonds, consensus, value over growth. Fairly consensus at the start of the year. That's changed up over the last couple of months. Here's the one for me. International over US. David Kelly, help me understand that a little bit more.
Well, of course, it's a long time coming, but the valuation story, I have never seen it more compelling. I mean, I was looking at the ratio of S&P, the ratio of PE ratios for the ACWI ex-US, everything outside the United States and the S&P 500. The rest of the world is cheap, but it's 2.5 standard deviations cheap. It's extraordinarily cheap. So this is a valuation call. I mean, unless we're living in different planets here, there's no way international stocks should be this cheap relative to US stocks. And that's why I wouldn't want to be underweight international. I would want to be overweight international, particularly if you believe in a cyclical rebound restarting here around the world. Europe and Japan are much more cyclical in terms of the sector distribution of their markets than the United States is, or indeed than China is. So I think that you really have to look at Europe and Japan as having a big opportunity in terms of cyclical rebound, and the valuations are just compelling here.
David, to what extent do you think that cyclicality embedded in the index for Europe compared to the United States actually goes some way to explaining the valuation gap?
I think it's some of that, but also we're stock market investors for the world. I mean, it's not just that 56 or 57% of stock market capitalization in the world is in the United States. That's where the stock investors are. I think U.S. investors are scared about investing around the world for lots of reasons, but I think that fear will diminish over time as the pandemic dies down around the world.
Sean, what about you? International over U.S.
Traders, it's time to play stop and profit even further. I'm going to play stop at 139.63.8. Okay, it will give us just right here 500 pounds in profit. Okay, you need to play stop and profit as well to 5 pips above your open position. And let's keep watching this pair. Speak to you later.
Discount to U.S. shares there, and they have a high dividend yield for the FTSE 100, 4.2%, and they're full of cyclicals, right? They have large banks, and then also energy. So if yields do trend higher, which is what everyone seems to think should happen, they should benefit.
Let's have a final word on that from you, Subhadra. We started this program, and I will have a series of guests through the next several months who will look at bond yields, and if we stay down here, they'll say we are not meant to be down here at 126, at 127. We need to go higher. And some people throw out the number 2. Seems to be an attractive number, Subhadra, to make a forecast. We need to go back to 2% on a 10-year. What needs to line up, Subhadra? What needs to go right or wrong to get us back to 2%?
Almost everything at this point, especially on the employment front. We need to be creating over 500,000 to 1 million jobs every month between now and the end of the year for the Fed to be able to be comfortable about tapering asset purchases. The real risk to our call is that inflation starts to rise quite a lot more dramatically, and the Fed starts worrying about normalizing monetary policy, and that could cause a flattening of the curve, led by the long end and front end yields rise. So what we really need is steady growth as well as employment gains for the remainder of the year. That's going to be key for the back end of the Treasury curve to start yields to rise.
Subhadra Jaffer alongside David Kelly and Sean Snyder. Guys, great to catch up. Appreciate your time. Some issues to work through the rest of this year, that's for sure. Looking ahead to payrolls now. Your July payrolls report coming next Friday. Here's the estimate so far in our survey, 900K on the button. That's what we're looking for at the moment in our survey. The median estimate, 900K, from a previous read of 850. Let's get you some price action at the market desk. Here's Abby.
John, coming into today, the S&P 500 was heading to a small weekly decline. Now in today's modestly bullish action, we are looking at a weekly gain if it holds into tomorrow, a second up week. Now helping out the auto space, Ford put up a very strong quarter. They beat on profit estimates. They also raised the outlook. That's true for VW, but you can see among the space, we have Tesla, GM, Stellantis, all higher, but Ford really carrying it away, up 6.2%. Again, they put up a great quarter and they raised the outlook. Turning to where we have some mixed action, Martin Marietta, the construction company, they missed second quarter estimates, but the shares are up slightly. They had been up even more, perhaps having to do with some optimism that maybe that infrastructure bill gets passed at some point. United Rentals, on the other hand, not so much, down 4.8%. They missed the second quarter adjusted estimate. Their free cash flow view a little bit weaker, so that equipment rental company down. And then finally, rounding it out with the top sector on the day, energy is in the green. Oil's not even up all that much, but you can see the reflation bulls, they are in charge today, John.
Very much so, with yields higher as well, as you've pointed out through the morning. Abby, thank you. Equities advancing 0.4% on the S&P. Up next, Facebook earnings adding fuel to rising growth concerns. That conversation still ahead with Brent Thill of Jefferies from New York. This is Bloomberg.
Access the financial world on demand. Hear from leading economists, policymakers, and industry experts via live and on-demand webinars, only from Bloomberg. Start exploring to see what's moving the markets. Visit Bloomberg.com/webinars.
Billionaires in space?
What defines going to space?
There is a level where you
It's
get...
the common line?
It's a common scientific theory, 53 miles, 62 miles.
I think that it's just being able to float around and then suddenly you feel like you can say you've been to space.
Zero gravity.
Zero gravity.
Surveillance correction right now. John and I went to Wikipedia. The Kármán line, John.
Yeah, the thing that I mentioned and you carried on talking and ignored me.
Stay grounded with Bloomberg Surveillance, weekdays on Bloomberg Television and Radio.
I think what we're seeing with all of these results and coming out of the pandemic is that tech is definitely no longer its own isolated sector. It really does reflect the greater economy.
Big tech earnings raising just a few small red flags, showing signs of decelerating growth this week. Facebook, the latest to stoke peaking growth fears. The company's CFO saying, quote, "We expect year-over-year total revenue growth rates to decelerate significantly on a sequential basis as we lap periods of increasingly strong growth." Katie Lyons has more. Hey, Kaylee.
Hey, John, well, it was a really solid second quarter for Facebook, revenue growth of 56%. The problem is that might not be sustainable. As you said, the company warning that we may see a slowdown sequentially in the third and fourth quarter, and they're blaming Apple for a lot of this and the new rules that allow users of apps to decide whether or not they want the apps to track them all across the internet, and that makes it a lot harder to target ads. So that is going to create a headwind for Facebook in the back half of the year. Revenue growth expected to decelerate to 36% and then 23%. And it's not just about revenue growth either. User growth also matters for these social media companies, and that too is slowing down, up yet less than 4% so far this year. 1.91 billion users of Facebook at the end of the second quarter, but that number failed to top expectations. Nonetheless, the street sounding positive after the results. We've seen a number of analysts raising their price targets on the stock. The question is whether investors will listen to that. Facebook was already up 36% on a year-to-date basis going into the print, and internet stocks as a whole have been outperforming other tech companies in the hardware and software sectors, up nearly 50% on a year-to-date basis for that internet index. The question is, John, if growth is slowing down, can that outperformance last?
Kelly, thank you. The stock is down by about 3%. Important to talk about where we've been. Kelly mentioned the recent rally. Look at how we were shaping up going into earnings last week on Monday, before we had the earnings from Twitter, from Snap, from Alphabet. We started 2 Mondays ago at 337, right now 362. Jefferies analyst Brent Thill maintaining a buy rating on Facebook, raising his price target to 425 following those results, anticipating a, quote, more limited slowdown in the second half. Brent, I'm pleased to say, has given us some of his precious time this morning. So, Brent, let's get straight to it. Why do you see a more limited slowdown?
I think digital advertising continues to ramp at an incredible pace, and you're seeing
a number of the other companies in the industry like Snap and Twitter give way more bullish forecasts. Facebook has always been more conservative, yet, sailed through those expectations. So I think you have to start with the company typically has a more conservative outlook. But if you look at what Snap said, 50% indefinite growth, Twitter doubling the company over 3 years, and then you listen to Facebook, it sounds like they're in a completely different industry, and they're not. And advertisers are still getting the best ROI in Facebook of any platform that is out there. So if you think about, again, Facebook stock has done very, very well, and they've kept a lid on the expectations. Yes, they have difficult comps. Yes, Mark Zuckerberg's talking about a completely new world called the metaverse, which if Facebook wants to invest, and spent a lot of time on the earnings call last night talking about this new world they're building. I think investors are saying, wow, it sounds like a lot more expenses coming into the system, and what is this metaverse anyways? So I think, there's clearly some cause for concern on the build out of the metaverse, and then number two, the slowdown of revenue growth. But ultimately, as you've seen for quite some time, Facebook's been able to deliver, and the stock is doing way better than the indexes. So we continue to favor it and believe in an $18 earnings story. You put a mid-20 multiple, and you're at $450 on the stock.
Brent, in many ways, it's a reflection of the broader conversation I have on this program every single day. What matters, the cumulative gains or the decelerating rate of change? I just wonder at the stock level, what gives you the confidence, just in terms of the reaction function of Facebook investors, that they will still appreciate the name as growth decelerates to some degree, sequentially in the coming quarters?
Well, remember across tech, right, we saw the surge during the pandemic and the stay-at-home. You saw a lot of names benefit, and ultimately, Amazon, the rest of the industry is going to go through much tougher comps, right? So is Facebook in the same water or different water than others? They're in the same water, right? You're going to see some deceleration. Number two, if you look across technology, right, software is literally, the valuation in many cases is living in the stratosphere, 30 to 50 times revenue in software. In internet, you can pay 25 times earnings for Facebook, which isn't crazy for the growth that they're giving you, and still get to 450 on the stock. So I think when you look at relative valuations, internet's cheaper than software.
Yeah.
Internet has the sphere of regulatory overhang, and ultimately that has gone nowhere. So other than just...
I'm going to move further. I will stop for British pound to 139.68.8. Okay, guys? Good trade. All of you guys who managed to stay with me, followed my trade, and get filled at the level I show you right now, almost 3:30. Yes, we entered position. Well done. You're already in really good profit. In our case, we have 1,000 pounds in profit. In your case, how much you decided to invest when you decided to trade these pairs? If you want to find out more about our strategy, how we trade, you need to go to companyeye.co.uk, and you need to get the strategy so you will understand how it works. You will practice a couple of times with us. We extract videos from live trading sessions. So if you will have some questions, something that you don't understand, you can use our videos. We have thousands of videos in our channel that you can practice, and you can become really good at entering position, closing trades by using our strategy. Okay? Stay safe, guys.
This ultimately fits into is Amazon is still a great story, but is going through the post-pandemic hangover, and we'll see some deceleration. And the question is, can they sustain, the other businesses outside e-com? And we think they can. Every company we work with is moving to AWS on the cloud side. Their advertising business is on fire. So we see some really good engines of growth, and do not believe the story is over.
Brent, it's always great to hear from you, sir. Fantastic to catch up. Thanks for your time this morning. Brent Thill there of Jefferies on some of the tech names this morning. Your equity market positive 0.4% on the S&P 500. Up next, your training diary. The road ahead into the weekend. From New York, this is Bloomberg.
Surveillance puts global markets into perspective.
We're going to try to fold an economic theory here with what we've got.
Based on data.
The focus is going to be on the data, the manufacturing data.
How the market responds will be really interesting.
Timely conversations.
Part of getting out of this hole is big fiscal.
Keeping you up to date on trends.
When do you take this thing off?
So you put it on to take it back off.
Wake up with Tom Keene, Jonathan Ferro, and Lisa Abramowitz. Weekday mornings on Bloomberg Television.
For the people here on Earth who are wondering why are we investing all this money in space, this time in space, talk to us about how you believe this will actually help benefit us here on Earth.
We're building infrastructure. This is a road. We're building a road to space so that future generations can build the future. We live on this beautiful planet. It's the most beautiful planet in the solar system by far.
Right now, about half of U.S. households invest. We'd like to get that number up to 95+%. Investing should be as ubiquitous as shopping online. It should just be something that people do.
25 minutes into the session, it's early days, but we advanced by 0.4% on the S&P. Outperformance on the small caps, the Russell up by 0.7%. The Nasdaq up by about 1/3%. The sector composition, basically everything in the green today, with the exception of communication services. Amazon still to come after the close. That's your next stop. Let's get through the trading diary. The path ahead into the weekend. We look like this. The Treasury auctioning $62 billion in 7-year paper, 1 p.m. Eastern. The President discussing the Delta variant from the White House at 4 p.m. Plus Amazon capping off big tech earnings, reporting after the closing bell. And finally, we round out the week with personal income and spending numbers tomorrow. From New York City, for our audience worldwide, thank you for choosing Bloomberg TV. This was the countdown to the open. This is Bloomberg.
Week on Bloomberg Green, the rise of green finance.
What we're trying to do is to have a positive impact in every investment and to future-proof those investments.
2021 is the year of sustainable finance, but how do we make sure that all of this money is as green as it's supposed to be?
We know the direction is clear, but the road will be bumpy.
The European Union lays out the green standard for bonds, tightening up rules for banks on climate change.
We see a real link between the impacts a company makes on workers and society and the community, but also on climate and the environment, on the long-term financial value of these companies.
And turning money into motion, the story of how one small activist investor took on an oil giant. I'm Danny Berger in London, and that's what's coming up on this week's edition of Bloomberg Green. Catch it on TV, Quick Take, and online.
People ask me all the time, what is the key to being a really good investor? And I tell them it's to surround yourself with and work with the best investors you can find. On Bloomberg Wealth, I'm going to take you to meet the greatest investors in the world, the people that I would like to have managing my money.
Some of the best deals in history have been passed on by a very large number of people. The money is made on the aberrations. And so I would say you want to be generally open-minded and humble about your conclusions about what all these different signals mean.
Months after Hurricane Maria, Puerto Rico is still in peril. Huge swaths of the island are still without power, running water, or access to medical care. Experts estimate that it will take years before these services are restored island-wide. Much of the blame has been placed on FEMA for a slow response in comparison to recent disasters on the mainland. But recovery from a disaster of this complexity and scale has proven more challenging than anyone anticipated. And filling the gaps between an overextended public sector and a suffering populace falls on the private citizens. Robert Anderson is a Puerto Rico resident of 4 years.
The eye of the storm came in south of El Yunque, swept up towards San Juan, and out to Arecibo. Everything on the right-hand side is what we call the dirty side of the storm.
This isn't his first time in a disaster zone. With a military and telecom background, Anderson worked on repairing damaged cell phone towers in New Orleans after Hurricane Katrina. Some might be tempted to label him a disaster capitalist, seeking lucrative government contracts for his expertise. But as Anderson finds himself in the middle of a humanitarian crisis, he and his associates are developing a variety of pro bono recovery projects that target the island's hardest hit areas.
I see two Puerto Ricos. We're here in San Juan. They have telecommunications restored. They may or may not have power, but basic services are in place. They're able to get food. They're able to buy things. They're surviving. And when you look outside of the San Juan area, you can go 15 minutes from here and find areas that are devastated. I'm working on the devastated side.
Today, he's put together a boots-on-the-ground mission to provide medical care to some of the island's most isolated and vulnerable residents. Steve Berenbaum is one of Anderson's business associates. He offered an extra car and a set of hands.
So we received an initial report from a nurse that was out in the area. We're headed to the northeast region of Utuado for some people that are in need of urgent medical assistance.
Dr. Sally Priester is a physician from San Juan. She filled a van with medical supplies at her own expense and brought along a team of nurses. Google Maps estimated our first destination to be a 90-minute drive. But it didn't account for obstacles like this. Our first stop was the home of an 82-year-old blind Vietnam veteran. His roof was blown off by the storm, and he's been living alone in a back shed for nearly 2 months.
His cane actually got broken in the storm, so he's limited mobility. He has a number of medical ailments. Dr. Priester's having a look at him. We called the VA. They're going to get him set up with what he needs, get him stabilized so he can then be transported either to an evacuation center or off the island. It's when the chain gets broken, when those families that are connected to them leave the island or take off, these guys get left at the end of the road, and it's tough.
FEMA was not officially part of Robert's team, and their arrival caught everyone by.
That's it, guys. This is how you day trade. We have £1,000 in profit. All of you guys who decided to follow Trade, well done. Who decided to follow our company. It took, what time is it now? 3 o'clock, 4 minutes past 3. We entered trade 20 minutes, something like 25 minutes past 2. Around 50 minutes, we made £1,000. If you want to get the strategy, you need to go to company.co.uk. I just want to remind you, this is not paper trades or some imaginary money. All trades are recorded. You can check all trades on our website, on our stream as well. We extract videos from live traded sessions. So all of this recording, all trades recorded. So you're welcome to check our channel. Okay, stay with me. Don't move anywhere. We will look for other good chance and opportunity to trade. So don't miss it. Okay, well done, guys. I'll speak to you later.
FEMA HQ, free of charge.
I have pretty good reach.
Perhaps that's how he managed to earn himself a coveted FEMA badge without actually working for them. And it's these relationships that allow him to operate more efficiently than an NGO or a government agency.
We're able to resolve problems at a different level.
next stop was on a mountaintop, a family of 11 struggling to care for their special needs brother in what was left of their house.
Probably we are the first health team to come and visit this family.
Muy bien, todo muy bien.
The patient has Down syndrome. He is all day in bed. The difficulty with this is the patient cannot be alone. The most important thing is that you need to take care of the chronic disease besides disability, because they have been not going to a doctor, and no doctor has come in here yet.
So we need a refill of this medication.
After maybe 54 days, it's not getting better. And the only way that you can be able to see that is coming to the ground, drive, and see the people and talk to the people.
You can see San Juan from here, but you can't get there. It's like the Emerald City.
On this stop, we caught word that a man living alone at the edge of the jungle was in need of care.
So we decided to take a little detour, come up here and check out and see what's going on. One of the challenges is to find those people that are at the end of these roads that need help.
¿Pero por qué estás solo? ¿Por qué estás por acá? I'm asking about why he's alone right here. He said things of life happens. Yeah, I'm here by myself. So ¿dónde vive acá? En la parte de... This is not a job. To do this, you need to have passion for what you can do. You're not going to get paid.
It's said in disaster response and emergency response that the real first responders are your neighbors. You don't need to wait for a lucrative FEMA contract to go out and do good and to help the community.
Ann, do you feel like you're making a difference?
Lives you touch and people that you can affect. I don't really think about it in those terms.
But why do you do it?
It helps me sleep at night. I think it's as much for the people that are going out to help and do things as it is for the people that you affect.
Whether out of altruism, or the lure of a paid gig, or some mixture of the two, Anderson hopes to stay here to help shape Puerto Rico's future.
Puerto Rico's essentially been a colony for 400 years. It was treated poorly by the Spanish. It was not treated well by the United States when they first got here. Puerto Rico can continue in the way that it's always been, or Puerto Rico can rebuild itself like nothing that's ever been. And we have to do everything we can to make that real. That's the bottom line.